SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Ladies and gentlemen, welcome to this workshop on macroeconomic models for monetary policy, state of play and way forward, which is jointly organized by SUERF, the European Money and Finance Forum, by the ECB, the Bank of Finland, and the Banca d'Italia. Economic models play a central role in modern central banks' assessment of the state of the economy, nowcasting, the forecasting of macroeconomic developments and of inflation over the relevant policy horizon, which is usually thought to be 2 to 3 years, the calibration of the adequate monetary policy stance and the adequate instruments, the appraisal of costs, benefits and risks of alternative policy routes, that is, scenario analysis, as well as the identification of long-term secular economic trends. The original idea to organize this workshop was the release of the Eurosystem report of the workstream on Eurosystem modeling, which was one of the results from the ECB's 2020-2021 strategy review, and which has also been published as ECB Occasional Paper number 267 last September. We have provided a link, meanwhile, of this report on the SUERF website. So I can encourage you to have a look at this thick report. It's 190 pages thick, and it's the Bible for all us economists, central bank economists, forecasters, model builders, and so on, in the Eurosystem at least. The idea was, first, that the three co-chairs of this workstream, Matthieu Darracq Paries from the ECB, Juha Kilponen from the Bank of Finland, and Alessandro Notarpietro from the Banca d'Italia, present key findings and conclusions from the Eurosystem report. Let me use the opportunity to thank Matthieu, Juha, and Alessandro for the smooth and professional joint preparation of the workshop. This was really a pleasure. Second, we wanted to compare the findings of this workstream with related work in major non-euro area central banks. We are very privileged and grateful to have with us today top researchers and model developers from the BIS, the Fed, the Riksbank, the Bank of Canada, the IMF, Norges Bank, and the Bank of England / now King's College. Third, the topic of central bank models and forecasts has gained urgency recently due to our collective difficulties, let's put it like this, in adequately forecasting the strength and the persistence in the rise of inflation in all our jurisdictions. For sure, our forecasts are based on assumptions regarding energy prices and other external supply factors, and our findings regarding the behavior of wages, profit margins, and inflation expectations according to past empirical regularities. So they are not forecasts, they are projections, as we used to say. But in the end, it doesn't help policymakers if we as model builders and as forecasters emphasize the conditional nature of our projections. Also, the public and the media, after several rounds of strong underpredictions of inflation, may raise questions about our credibility. Now, beyond these short-term challenges, there are also major long-term structural changes which challenge us as economists, as model builders, as forecasters, and as stress testers. The possibility of deglobalization, aging, and climate change and the energy transition may exert price shocks and alter the medium to long-term trend of productivity growth, of R* and inflation, among other things. The workshop will translate the very technical modeling work that is conducted by colleagues presenting here, and probably also by most of us participating here, into a policy-oriented format accessible to economic policymakers, financial practitioners and economists active outside the narrow field of economic modeling and forecasting. The aim is to provide orientation of the multitude of evolving work streams and approaches, to encourage benchmarking and cross-fertilization between institutions, and to link interested researchers. We hope and are confident that today's event will only be the first such gathering and that will open avenues for future cooperation and exchanges. You have all received the program. There will be 3 sessions on, first, the evolving role of macroeconomic models in central banks' monetary policies, key lessons from recent strategy reviews to the extent that they were done. Second, model development needs, themes and priorities. And third, how to improve the use of models for monetary policy. Without further ado, I hand over to Fiorella from the BIS to moderate the first session. Fiorella, over to you.
Thanks so much for asking me to chair this first very interesting session on the evolving role of macroeconomic models in central banks' monetary policies, key lessons from recent strategy reviews. So what I thought I would do to introduce the session is to briefly highlight the outcome of the 3 main strategy reviews that we have seen in the world over the past 18 months. And then I will share my views on what I think is the role that has been played by macro models in those strategy reviews. And I will conclude by pointing to the current challenges for monetary policy frameworks and their implications for our models. So the first review that was concluded among major central banks was at the Fed. This was concluded in August 2020 when Chair Powell communicated the key changes to the statement on longer run goals and monetary policy strategy. And the main change was a move to a flexible form of average inflation targeting that allowed the Fed to overshoot the target following period of protracted undershooting of inflation relative to the target. Another key change was the introduction of a reference to shortfalls of employment from its maximum levels relative to the previous formulation in terms of deviations from maximum level of employment. And there was also a dropped reference to the quantitative measures of natural rate of unemployment, which was deemed to be hard to quantify. And this was accompanied also by an enhanced emphasis on employment relative to inflation and to a strong and inclusive labor market. That being said, it was, the strategies was driven by the perception that the fall in the natural rates were reducing the policy room for the Fed. And so there was an explicit commitment to use the full range of available unconventional monetary policy tools developed over the past decades. And it's interesting to notice that there was also, for the first time, perhaps, an explicit reference to financial stability as the necessary condition for the achievement of maximum employment and price stability. And the review ended up with the commitment to carry out a strategy review on a regular basis every 5 years. The second review was concluded by the ECB in July last year. And the key change there was the move to a symmetric inflation target of 2% over the medium term. And that, the difference relative to the Fed is that allowed, did not commit the ECB to overshoot inflation after periods of persistent undershooting of relative to the target. This view also communicated that it would use an integrated analytical framework that combines economic, monetary, and financial analysis. So clearly, the 2-pillar idea of the strategy. And there was also an emphasis on improved communication with, in particular, a reference to a streamlined monetary policy statement that should facilitate communication with the large public. And 2 more ingredients of or outcomes of the strategy review were two roadmaps. One was more of a statistical nature for the inclusion of owner-occupied housing costs in the HICP, and the other was a very ambitious and comprehensive plan to incorporate climate change considerations into the strategy. And these entailed the developments of new models, consideration of environmental sustainability as a further eligibility criterion for the use of private sector assets as collateral or for asset purchase purposes. The fact that climate change risk should over time be considered for valuation of assets and also for the risk assessment of those assets. And the fact that the climate change criteria could be used to guide the allocation of a corporate bond purchases. And again, also the ECB concluded that the review of the monetary policy strategy should now become periodical, with the next being expected in 2025. And the last main strategy review was that of the Bank of Canada, completed just recently in December 21. But the Bank of Canada had already a regular review, so this was a completion of a 5 years agreement on the framework. The outcome was that flexible inflation targeting remained the cornerstone of the strategy, with the 2% inflation targeted casted into a 1 to 3% range. There was a recognition that interest rates are lower than in the past, and this provides less room for monetary policy. And so the Bank of Canada should also extensively use the available set of monetary policy tools when circumstances require it. Another consideration was that aging, technological change, globalization, and other structural shifts have impacted over the past the labor market. And so there was a new emphasis on aiming at a strong and inclusive labor market. And this would require the use of a broader set of labor market indicators that would favor the achievement of maximum employment and the targeted inflation rate. And it's interesting to notice that this agreement was reached after also referring explicitly in the communication to a model-based horse race of alternatives strategies relative to the chosen flexible inflation targeting. It was a comparison of alternative mega strategies and also a comparison of flexible inflation targeted to the dual mandate. So what is the role that has been played by models in the reviews? I think the reviews, emphasize the importance of models for monetary policy. In particular, the DSG models became very important because we had no data to assess alternatives to the previously existing strategies. And so they were used to evaluate the impact of the zero lower bound on the macroeconomy, but also the effectiveness of alternative monetary policy strategies. Flexible inflation targeting versus a set of other makeup strategies versus also dual mandates. They were used to look at ranges versus point targets. And they were also used to assess the role of agents' expectations for the effectiveness of monetary policy strategies, very importantly so. But also econometric models of a more reduced form nature played an important role, in particular for the comparison of the effectiveness of individual and conventional monetary policy tools and for their combination. And there was also an increased role for projection models that were used for some central banks to operationalize the threshold-based forward guidance. Overall, what I think is that there has been a more limited use of models in guiding other important choices, such as those on the labor market goal, more precisely whether there should be shortfalls or rather the maximum level of employment, and whether the labor market should be inclusive or not, and what it exactly means. There were also less details provided by models on the implementation of a climate change. on the operationalization of the plan on climate change. And also, I saw a bit less use of models to design the best strategies to improve communication and the effectiveness of monetary policy in view of the agent's reaction. Now, what are the current challenges for monetary policy frameworks? So what does it imply for models? First, I think that an important question we need to face is whether the renewed frameworks were fit for the pandemic. So did we ex ante correctly price in the risk arising from supply relative to demand factors? So the zero lower bound concerns that we all had in mind when these strategy reviews were finalized. And how flexible are the strategies that were adopted to quickly rising inflation? So, for instance, think of the link that the enhanced forward guidance of the ECB has now to projections and to projected inflation, or the constraint that is imposed by average inflation target in a maximum employment at the Fed in reacting to rising inflation. So, do these new frameworks run the risk of running behind, run the risk that the central banks are running behind the curve because of this new adoption of frameworks? And second, what role is there for monetary policy in addressing climate change related risks and policies? You know, is there any optimality consideration concerning the climate change criteria that you know, that are discussed in relation to deviating from market neutrality in the asset purchases? And is there any optimality related to the inclusion of climate risk in the risk assessment of collateral framework? I think these are important questions. And finally, I think that our models need to address the current challenges that central banks are facing from financial innovation, in particular, the role of big tech and fintech in their emerging role in finance, and also the threat of digital currency for central bank money, so cryptocurrency and central bank digital currency. So let me stop here and let me stop sharing. And I think I will then pass give the floor to the presenters. I think the first presenter is Alessandro.
So thank you very much, Fiorella, for your nice introduction. And let me also thank Ernest and SUERF, as well as Juha and Matthieu, for organizing this workshop. And I hope we'll be learning a lot today from colleagues from other institutions around the world. I'm going to be talking in my short talk about macro modeling strategies in Eurosystem. And of course, the usual disclaimer applies. As Ernest said, my job, as well as Juha's and Matthieu today, is to present part of the outcome of this occasional paper that was published in September last year. Ernest did a great promotion, so I won't spend much time on this, but let me just say that it was a pleasure for me personally, and I guess for Juha and Matthieu as well, to co-lead this group that works on Eurosystem modeling, which was active during 2020 and 2021. We had a lot of contributors from NCBs and the ECB, and you know, the output of our work stream is basically contained in this long but hopefully interesting occasional paper, which deals with a lot of issues related to the current macroeconomic modeling strategies in the Eurosystem, as well as possible analytical gaps that we identified, and you know, challenges in the use of models for policy analysis. The three of us are going to be talking about different issues that are tackled in the paper, and in my talk I'll be talking mostly about you know, the types of models that are used within the Eurosystem, and also you know, the use of these models in the policy process. So I will start with just a few definitions, or just defining the angle that we take in serving these models. And let me remark that the results are based on a survey that we ran in summer of 2020 among national central banks, with the help of the WGN, that is the Working Group on Econometric Modeling, that includes the ECB and national central banks from both the Eurosystem and the ESCB. Then I'll be more specific about what kind of use we make of these models in our regular policy work within the Eurosystem. And I'll also conclude with a few words on benchmarking. So one thing we included in our paper was, how do we compare to what other institutions do? That is, what do other central banks, but also other institutions, such as the IMF and so on, do in terms of modeling when it comes to policy analysis. So let me start with a few words about like sort of setting the rules of the game for us. The models that we are dealing with in our review are those that are regularly used for forecasting and policy analysis within the Eurosystem. So we decided not to consider models that are developed within, say, research projects, not because they're not interesting, in fact they are, but because we are mostly focusing here on the policy activity and the regular process of supporting projections and monetary policy decisions. Of course, it will probably be the case that some of those models that are developed within research projects in a few years or maybe months will be used for policy analysis, but our was a sort of a snapshot of the state of the art. One main result, probably the most important one, is that there is an extensive use of models in the policy process. And typically, national central banks, as well as the ECB, uses what we call a suite of models approach. So there is not just one single model. As you will see, there is specialization, but there is a lot of cross-validation. So we use a lot of instruments to tackle one question. So this table here is providing a lot of information. So let me just walk you through a little bit of details. So on these rows here, you find a classification or sort of a taxonomy of the most relevant models that we are dealing with. So we're talking about structural models, that is mostly DSG models, semi-structural and time series. So in a sense, structural models are those that allow you to provide a narrative around numbers or to provide a description of what the driving sources are in terms of business cycle and transmission of policy shocks or policy decision in general. Semi-structural models do have the ability of doing so, but to a lesser extent. And in a sense, the main difference, as I will argue in a second, as I'll remark in a second, relies in the structural interpretation of the drivers. So there is more flexibility here in a sense. And then time series models are mostly reduced form, but again, they can be used for the same type of analysis. Let me also remark that we did not deal with higher frequency models, so like short-term forecasting. So in a sense, in a very sort of, in an oversimplification, we could think of this as being really a snapshot of quarterly models in a sense that are used for forecasting and policy analysis mostly. In terms of geographic coverage, all central banks have at least one country-specific model they use. Of course, the ECB also has euro area models. That's quite clear. But when it comes to monetary policy and other types of use, national central banks also have at least one model that includes the whole Eurozone. So it makes sense to have such a tool when it comes to analyzing the effects of monetary policy decisions, mostly through, for instance, trade spillovers and so on. And then for the same reason, it makes sense to also have global models or multi-country models that allow for a meaningful analysis of cross-country, but also spillovers, with other regions in the world economy. And you already see here sort of the main policy exercises or activities. So going more into details, there is quite some specialization here in the sense that projections are typically run, but not exclusively, with large semi-structural models. There are exceptions to this, and in some cases, the use of semi-structural models is accompanied by structural ones, but a large majority of central banks use these models for the projections. The reason being their flexibility and their ability to incorporate data and information in a quite flexible way. So in a sense, there is a sort of trade-off between complexity and flexibility here. In terms of nature and geographic coverage, they are mostly country-specific. The reason is These models are used to run projections that, are typically country-specific ones. Here, institutional rules do play a role in the sense that Eurosystem projections are typically run in a country-by-country bottom-up sort of way. So each country provides projections about its own jurisdiction. So it makes sense to have this type of model. Let me also say that these exercises are harmonized across the Eurosystem, and that means there's a common set of conditioning variables among these interest rates, for instance, as well as oil prices and exchange rates and so on. So one feature of this projection model is that, for instance, as interest rates are conditioning exogenous variables, the yield, the effective lower bound and the involved nonlinearities are typically not explicitly known. Not necessarily in all cases, but this is typically less of a concern because the interest rate is at a conditioning. So this is, I'm already sort of anticipating something that, for instance, Juha will be talking about in his presentation about possible analytical gaps to be filled in. Structural models, well, scenario analysis is typically done with DSG models, although in many cases this is done jointly with semi-structural models. That depends on the scope of the analysis, but the most important thing here is that structural models are used to complement the baseline projection with a narrative, but they also allow to do some analysis of policy announcements, for instance, because of an because of an expectation channel that is typically, but not always, absent in semi-structural models. One exception is the FRB US model that, well, Banque de France recently has adopted a model that is developed along the line of the FRB US, and in that case, expectations do matter, although it's a semi-structural. But more generally, DSG models allow for this type of analysis. For instance, there's a larger emphasis on open economy dimension and the interaction of monetary and fiscal policy. Again, we're not dealing here with other sort of satellite models such as short-term forecasting, but let me just mention that we have witnessed a lot of activity in that area since the beginning of the pandemic, which was important. So just to put numbers here, this table is just providing sort of an accounting. So this is what I just said. Projections are typically run with semi-structural, sometimes also DSG, but mostly semi-structural country-specific models. Typically, central banks do monetary policy simulations with both country-specific models, which may be structural or semi-structural, and also euro-area models. Global economy models are also used. They are not necessarily developed in-house. Sometimes they're taken off the shelf. That could be the case with the IMF's GIMF model, or the NIGIM, or the EAGLE model that I'll be talking about later. And the same applies for other policy use, like the study of fiscal policy or trade policy more recently. This is pretty much the type of instruments that we use. So again, one thing that I would like to emphasize, which I already anticipated, is the extensive use of model, but at the same time, the use of different models to sort of tackle the same question. So that provides a sort of a robustness check along the way. So just to see these tools in action, I'm referring here to two prominent examples. One is the projections exercise, and another one is the regular monetary analysis and assessment of monetary policy stance. So when it comes to the projections, I'm referring here to the broad macroeconomic projection exercise. That's the one that involves national central banks in the Eurosystem, but also to the MPE, which is the one that directly involves the ECB. All these processes are largely model-based. As I said, there are common assumptions and models. So as I said, mostly semi-structural models are used to provide a consistent framework to produce the baseline forecast, and to also take into account expert judgment, which is also an important feature here. But let me stress that the role of judgment is just a complement to the model-based analysis. And then on top of this, we have sensitivity analysis underlying the projection assumptions. So a typical example is what, these are what-if scenarios. So what happens if oil prices are higher than we thought, or when we set up the conditioning assumptions. And these analyses are for instance, running the structural models around the baseline projection. And when it comes to analyzing monetary policy or assessing the monetary stance, one exercise that is typically done is, the use of different, a battery of models, structural ones, such as DSG, and also VAR models. So this is regularly done within the Eurosystem to analyze the impact of monetary policy decisions. So before I conclude, there are just two more things that I want to mention. The first one is, from all I've said so far, it sort of seems like every NCB is running their own models, and sometimes there is overlap, sometimes not. But let me also emphasize that there is a lot of cooperation, which mostly works through the Working Group on Econometric Modeling, the WGM. And here I'm just mentioning one example of a joint macroeconomic modeling effort within the Eurosystem between the ECB and the NCBs, which is the development of the EAGLE model, which has been around for about a decade now. And that's a DSG model that is regularly used across NCBs and at the ECB for scenario analysis and policy simulations. It provides a common platform, so it's really like a common language that we can use to analyze the impact of policy measures, to analyze policy spillovers, to analyze open economy and international spillovers as well. And as I mentioned here, this is being used to analyze a number of issues over the years. But the most important thing is it provides a common platform across to analyze monetary policy and other policy issues. So just to conclude, as I said, we also did some benchmarking against other institutions. And as far as we understand, but this is where we are really looking forward to hearing from colleagues from outside the Eurosystem, this type of pseudo-model approach is quite common across the globe, I would say, and most institutions use more than one model for projections and, of course, also for other policy uses. And yeah, we're looking forward to hearing from you. So just to conclude, let me just remark a couple of points here. The first one is we have seen, we not only witness an extensive use of models in policy analysis, but we also notice a significant improvement in the modeling toolkit since the 2003 ECB strategy review. That involves all sorts of models, and in particular projection models and structural ones have proved resilient over the last decade, which included 2 crises in the Eurozone, and models were quite rapidly tweaked and modified to account for instance, the role of financial factors, but that's just one example. And the same applies to structural model. So looking forward, of course, we identified areas where there are some possible gaps that could be filled in, both from an analytical point of view, and that's what you will be talking about, but also in the policy use, and that's going to be the topic of Matthieu's presentation. So I'll just stop here, and in the interest of time, just refer to the next speaker or the questions. Thank you.
Thank you, Alessandro. That was very, very interesting, comprehensive to have an overview of all the models used at the Eurosystem. So we have 5 minutes to take questions. So please either put them in the chat or raise your hands raise your hands, and then I will give you the floor. Maybe just to kick off the discussion, I was just curious, what is the plan for model development as far as it concerns climate change and operational details? Is there any model that is already has a block or that is already suitable for addressing those questions, or is it really a plan that still needs to be materialized? Thank you.
No, thank you. That's an excellent question. So when we run this survey, that was almost 2 years ago now, we included questions about that because, of course, that was already topical, maybe less than today, but and from the answers we received from central banks, it seems like a typical answer was yes, we are moving in that direction, but the state of the art is we don't have many models that are ready in the hands of researchers and economists within your system to be effectively used as of now for policy analysis, with a few exceptions. So we had, I believe it was the Dutch National the Dutch central bank, if we have any colleagues around, they had some analysis, which, as far as I know, used the Niger model. So that's not directly maintained and developed by them, but it's got a block that allows you to analyze climate change. And then in terms of which type of models, there's a lot of discussion. Our sort of sense was that it makes sense to develop something that needs to have some specific features, that is some global dimension, which makes sense given that, you know, these policy issues imply the use of resources, and, you know, price movements and trade movements are going to be essential in the study of the consequences of policy measures such as carbon tax and so on. So one recommendation sort of that we came up with was to go in that direction. But as of now, we did not receive many answers in the sense of people having a lot of analysis already underway. Thank you. I think we have a...
Thank you. Yes, we have another question. I don't know if you see it in the chat from Massimo Cingolani, who is asking whether it isn't strange that central banks use the ESG models for policy scenarios when it's known that they essentially exclude money and banks, and whether this doesn't entail an implicit assumption of money neutrality.
Okay, so as far as money neutrality and money is concerned, no, I mean, we all use cashless economy models, but that doesn't imply neutrality. But in terms of banks, no, one thing we noticed is, for instance, that that's exactly one of those directions in which we have seen a lot of work in the past decade, and definitely compared to the previous strategy review. So in the case of the ECB, for instance, and colleagues could just jump in whenever they want, but one thing we noticed is the new area-wide model, which is largely used for policy scenario analysis, was recently, like just a few years ago, enriched with a financial and banking sector to analyze those type of issues. And in many other cases, central banks have worked a lot on developing banking sectors in those models. So I think we're well equipped. Thank you.
Great, thanks. There is another question, maybe we can still take that and then we move to the second paper from Yalal Kwanas. He's asking, or she's asking, sorry, are there other models that can be used, such as agent-based modeling and stock flow modeling? Is there any discussion of these alternative models within central banks?
Yes, we mentioned the existence of these alternative models, I believe. There is some discussion. The thing is, as I said, we concentrated on those models that are routinely used, and then we try to identify possible ways looking forward. I haven't seen much use of agent-based models specifically in the field of monetary policy as of yet, but I'm, of course, willing to discuss this more. Thank you.
Thank you, Alessandro. I think we can move to the second paper by Fabian Winkler, who will give us the perspective from the Fed.
Thank you very much for having me, and thank you to the organizers for getting this great program together. And I'm very excited to hear more as the day goes on. I'm going to talk about some aspects of the staff's work for the Federal Reserve's framework review, which now is already almost 2 years in the rear mirror, but still I think is very relevant for today's economic circumstances. And of course, these are my own views and not official views of the Fed or anyone else in the Fed. So we did not have a formal review of our modeling approaches for the framework review, and I find this very impressive, the effort that Alessandro just outlined to sort of get an inventory of the different models that are used at the ECB. I think that'd be something that would probably be quite useful for us too. We didn't do that for the review. Instead, we really just relied on the research expertise that exists, at the board and across the Federal Reserve system to form small groups of economists that worked on different topics that were relevant for the review, and these teams worked using their own methods of choice, I would say, and that culminated in a series of 13 memos that were presented to the FOMC, and those are publicly available now. And in terms of the model use, I think we really did have an eclectic mix of models. Really, we relied a lot, of course, on our standard FRB US model that we're always trying to improve and complement by other models too, but it sort of still remains the standard model that is in use for policy analysis. We also use an integrated balance sheet model that integrates FRB US with a model of the evolution of the balance sheet and term premium effects. We used heterogeneous agent models, small scale new Keynesian models, depending on the question at hand for the particular topic. So it was really an eclectic use of models. And what I'm going to focus on in this presentation, I'm not going to give you a sort of a broad overview of the review or the modeling approaches. Instead, I'm just going to focus mainly on the effort that I was involved in, which was the fifth memo that concerned the modeling of expectation formation and the robustness of the performance of makeup strategies, in particular to expectations. And I hope that you'll find that useful. We did 3 modeling exercises in that memo, and I'm just going to talk a little bit about each of these in turn. The first exercise was, really motivated by the question, well, what if there's an incomplete understanding of a makeup strategy such as average inflation targeting? The motivation, of course, as Fiorella already said, is that crucial to the performance of makeup strategies such as average inflation targeting in theory is what's called the expectation channel. The idea that if inflation or aggregate demand more broadly is low today, the promise of future higher inflation, the promise by the central bank that it will engineer or allow inflation to potentially overshoot its target will be some outcome that is expected by agents, and therefore will raise aggregate demand today and will raise inflation today, thereby also lowering real rates. And that's the powerful channel through which these strategies are supposed to operate. But of course, that means that the strategy and its economic implications need to be well understood by the public. So what we asked in this first exercise is, well, what if only parts of the public understand the new strategy? Financial markets, for example, seem to be very much attuned to finding out what the central bank wants to do, but households may pay less attention. And so here we could rely on the FRB US model and its semi-structural nature that still is able to model expectations in a forward-looking way. In particular, we can model expectations separately for the different blocks in FRB US. So there's an asset pricing block, which is broadly financial markets. There's a price setting block, a wage setting block, a consumption block, and so on. And so what we could do is we could sort of separately model expectations in these blocks and say, well, suppose that households have a very good understanding of a new strategy, or suppose that firms or financial markets have a good understanding. What would that imply through the lens of our model for the effectiveness of strategies such as average inflation targeting? And the main result that we found is that, again, through the lens of our model, AIT is effective as long as financial markets understand its implications, even if other agents in the economy, such as households, don't pay attention or don't have a good understanding of the implications of the new framework. And that happens because financial markets are the ones that ultimately price long-term borrowing rates, and these are the objects that govern spending and aggregate demand in our model economy. That was the first result that we found. The second result concerned the behavior of longer run inflation expectations. So there is a worry that a commitment to overshoot the inflation target can lead to an increase in long run inflation expectations, or sometimes called unanchoring of long run inflation expectations. And we wanted to know, well, what do unanchored long run inflation expectations do to the performance of a makeup strategy? And so here again, we could rely on FRB US, where the Phillips curve that governs the behavior of inflation allows for time varying expected trend inflation, which is modeled as sort of really like a moving average of past inflation, meaning that people's inflation expectations in the long run are really a result of their accumulated past inflation experience. And so we can model we can adjust the sensitivity of that to current inflation experiences. And what we found there is indeed that more sensitive longer run inflation expectations do imply a cost for these makeup strategies, because if you overshoot the target and inflation expectations rise as a result, that will mean that in order to then go back to the target state of the economy, you will need to tighten policy rates faster and incur a decrease in aggregate demand in order to slowly rein back these inflation expectations that are slow to build up, but are also slow to bring back. And that can be a potentially substantial cost of pursuing these strategies. The third exercise is the one that I want to spend a little bit more time on. Well, basically because we spun it off into a paper, but also because it's something that goes a little bit beyond the standard FRBIS model. It's a bit more innovation over what we have. And there we were really concerned with the transition between policy frameworks. So most models, at least the ones that we use, either assumed what's called rational expectations about monetary policy, where everyone understands what the central bank is doing and its implications, or there's some sort of permanent cognitive or behavioral frictions that make it so that there's a limited understanding of the implications of monetary policy. But we think that there may be an in-between case that's interesting to look at, which is that the public may eventually act quite rationally, really, but it may take time for it to learn that a new policy regime is in place and to learn its implications, in particular to learn it from observing the policy actions. And so that's what we try to get at. So I have this one slide with equations, but I hope that's permissible for the rules of this workshop. But just to give you a little bit of a flavor, what this learning framework does is that you have economy as your favorite system of equations. So here, think a small new Keynesian model, and then the central bank that follows a policy rule. First, it's subject to an effective lower bound, so it cannot lower rates below some level IBAR. And then the desired policy rate is some policy rule that is standard in the literature, where you can either react to inflation, and then you're sort of a flexible inflation targeter, really, or you can react to the price level, and then that makes you a price level targeter. So in this paper, we look at price level targeting. For the review, we did average inflation targeting, and the results are quite similar, really. So here we'll contrast a switch, hypothetical switch from inflation targeting to price level targeting. And the twist is that agents observe what the central bank is actually doing. So they observe this nominal interest rate that the central bank sets, but they do not observe these rule parameters. And so they have to learn from observing policy actions. And so what that means, and you may like this assumption or not, but what it's trying to capture is that in this world, policymakers can't talk the talk. They have to walk the walk. They have to actually show the public that they are setting interest rates differently from what they had before in order to convince the public that something's changed and in order to affect their expectations going forward. So that's broadly the framework that the learning method that we set up. And so we had a few interesting results of this analysis, and I'll point out what I think are the most important. The first one is that, and that's not surprising in the academic literature, but still important, I think, to point out, is that when you adopt this new framework, but agents have to learn about the new framework, is that you end up with an interim period where you actually have higher volatility and less stabilization of the economy than you otherwise would. You eventually end up with lower volatility, but in the transition period, you may have adverse consequences. And why is that? Is because agents learning and agents updating their beliefs and making mistakes about their expected evolution of the economy as a result of the framework change is itself a source of volatility in the economy. And that in the first time after the adoption of a new framework can very well lead to more volatility than if the public immediately understood the new strategy. The second result concerns the adoption of a new framework at the onset of a recession. And so here, so we produced new charts 2 days ago that are supposed to capture a little bit more current economic circumstances. Initially, we had simulated just a recession where inflation goes below target and then sort of slowly comes back up. Now we have a scenario here where after the recession's over, you have also an inflation surge. And so that arguably may represent a little bit what we're in right now. And so what you see here is that you have a recession where output falls, inflation falls, and as a result, the policy rate is lower and actually is constrained by the effective lower bound. And the blue lines, I hope that you can see those, are under inflation targeting. If you don't change the framework, then you get your garden variety DSGE model recession with some inflation shock afterwards. And the red line is what happens if you adopt a new price level targeting framework, and everyone understands that. And in a perfect rational expectations world, and you can see from the behavior of inflation, and that is great. You stabilize inflation through the expectations channel. You avoid a shortfall of inflation, and also subsequently you have to engineer an overshoot of inflation. But actually, you also get the stabilization benefits when you get that inflation surge over an outcome if you hadn't adopted a new target. So the stabilization properties also work the other way when you get an inflation surge. So it's really a great world to live in. But our learning simulations, those are the ones that are in the yellow lines here. Those paint a very different picture, and we sort of caution in this paper that if you adopt the framework at the beginning of this recession, you may end up getting no benefits of the strategy, but still bear all the costs. Why is that? Is because at the beginning, when you adopt a new framework, the public still hasn't understood or maybe only partially understood the new strategy and still behaves as if you were under the old framework. As a result, inflation drops just as much in the recession as it would had the new framework not been in place. And later on, when we have now this inflation shock after the recession, you also end up with higher inflation than you otherwise would. Why is that? Well, because you're now boxed yourself in. You have to make up for this inflation shortfall. You promised to make up for it. You have to honor your promise, and at the same time, you're also hit with this inflation shock, and you have to and you don't get the stabilization properties because there's still a partial understanding only of the strategy, and so you don't get the stabilization properties in that area either. So it's really not a good place to be in, and the reason why it takes so long in this particular scenario for agents to understand the new strategy and therefore for the stabilization benefits to materialize is actually a couple of things.
Fabian, maybe if you want to take one or two questions, you should probably wrap up in the next 1 or 2 minutes.
Oh, I'm sorry. Okay, sure. Yeah. This is the last thing I wanted to show. So let me just say that there is this episode where you constrained by the zero lower bound. That's a period where it's very difficult to learn anything about the new framework, because both the old framework and the new framework would imply being at the ELB. And later on, when you have made up for the price level gap, you're in a situation where when you have already sort of made up the price level target, that's the question. Well, what do you do next? Actually, in that very situation, makeup strategy and inflation targeting look very similar, and it's also very hard to discern these two strategies, and learning is slow. Okay, so I'll stop here. Thank you.
Thank you, Fabian. So again, just raise your hand if you have a question, or just drop it in the chat. Yeah, maybe I was just curious on this last example, very interesting one that mimics a bit the current situation and the slow learning of agents. This is based on a rule, Taylor type of rule, right? So that's not, because I was surprised that despite the slow learning and the bad outcome in terms of inflation, the interest rate doesn't show any difference. The path of interest rate is pretty similar in the various cases. So I was wondering, under the optimal policy, wouldn't the bank then accelerate the lift off to be able to teach the agents that inflation, by achieving lower inflation?
Right. I mean, yeah, you picked up very well on that point. That's true. So I mean, I think that particular point of the interest rate behavior is somewhat model specific. So if you use we do this now for the purpose of this paper in this very small 3-equation model, and there you don't really see that much because inflation varies so much that it actually offsets the interest rate behavior. But qualitatively, you do have this effect actually that the central bank will react to that and set interest rates. It's not very visible on the charts, but the effect is actually there. So you do get that.
Great, thank you.
Thank you, Fabian. There are other types of learning frameworks also, like the one used by Evans and Honkapohja, for example, maybe perhaps a little bit more backward-looking learning system. Can you speculate how would it change your results, perhaps, if one used that kind of a framework?
Right. Yeah. So yeah, my speculation is it would probably be quite similar. I mean, there is a bit of a question of how to apply that framework when you have this zero lower bound constraint, but I know that they have made some progress in that respect too. I think it would be similar. What we were trying to do here is to sort of is to sort of just focus on confusion about the central bank's policy strategy. In that framework, you would additionally have agents to learn about, the determinants of inflation and how the Phillips curve behaves and all of these things. I mean, at least expected inflation and the Phillips curve behaves. So there would be a lot of things going on. I think it'd be great to look at that too. Here, we really just wanted to focus on the learning about policy in particular. Yeah.
Thank you. Then the next paper is by Ulf Söderström. Floor is yours.
Thank you very much to the organizers for inviting me. It's a pleasure to be here in this workshop, which is super interesting for us who are into macro modeling and monetary policy analysis. So what I wanted to talk about is to give a bit of a Swedish perspective on modeling monetary policy. So the Riksbank has not done a strategy review recently. So I thought I'd talk a bit broader about challenges that we face or have faced when it comes to modeling, and challenges that we will probably continue to struggle with in the near future. And of course, anything I say is just my own views and no one else's, and so on. So a bit of a Swedish perspective. So these are just some background facts about the Swedish economy and monetary policy in Sweden. They're by no means unique to Sweden. We share these with many other economies and central banks. So in Sweden, of course, I mean, we have an independent monetary policy with an inflation target. So as many central banks working with monetary policy, that means that we need to form a consistent view of the macroeconomy, financial markets, and monetary policy. Of course, that's one reason we use macro models to try to help us to form this view. And we also need a very good grasp of the monetary transmission mechanism to understand what is a good monetary policy and a good way to respond to various shocks. Of course, we share this with most central banks. We have an executive board who makes monetary policy decisions with 6 members, and they have individual accountability. And we publish transcripts of our monetary policy meetings very soon after the meeting, which means that these 6 members will have different views and different preferences, and those will become public pretty soon after the meeting. So in our exercise when preparing monetary policy decisions, we may need to cater to many different preferences and many different views, which can sometimes be a challenge. We are, of course, a small open economy, as many other inflation targeting central banks. So we need to take into account, importantly, what happens in other economies and model international spillovers. We are trying to maintain a high degree of transparency at the Riksbank. So we publish a large set of forecasts, some 50 variables. And that includes forecasts for our monetary policy instruments that we publish externally. And of course, we have a high ambition to explain monetary policy and why policy is done in the way that it is, including why the forecast for monetary policy looks the way it does. And the final thing is that since 2015, we are running a large-scale asset purchase program, first starting with only government bonds, but in more recent years, also including private bonds in the form like covered bonds and corporate bonds and so on. So our current holdings are approximately 18% of our annual GDP. So it's a fairly sizable portfolio that we're holding. So I thought in particular, I would talk about 3 of these, the 3 last points and the challenges that gives us in terms of modeling monetary policy in Sweden. So let's start by saying something about international spillovers. I think this is something that we will get back to later in the workshop. Of course, as a small open economy, we're very heavily affected by what happens in foreign economies, and perhaps especially in the euro area, which is close to us. So international developments are unsurprisingly quite important for the Swedish economy. And there's one illustration of that is a paper published in our economic review a few years back by Jesper Lindé and Ernest at the Riksbank. Of course, these spillovers take the form of real spillovers. There are financial market spillovers and also for monetary policy. So all of these we need to take into account. But as many of you probably are aware, there is a famous paper by Alessandro Notarpietro and Bruce Preston from, well, it's now more than 10 years ago, who showed that structural, at least DSG models, they imply very weak international spillovers. And that's, of course, a challenge if you want to use DSG models in a small open economy, because if you think that spillovers are important, but your model doesn't capture that, well, that's going to be an issue that we have been struggling with for quite some time. But that was also the main focus of our recent review of the Riksbank DSG model that we finished a couple of years ago. So in the end, what we did was to choose to introduce two different global trends to capture trend co-movement. So these are trends in productivity growth, but also in interest rates. And we also introduced correlated shocks between the Swedish economy and the foreign economy. So I think this is a reasonable and quite pragmatic way to do it. But obviously, it doesn't mean, it implies that we don't really have a deep understanding of where these spillovers come from and what drives them. So that's something that we're still, that would obviously be useful to have a better understanding of this. It seems to me that there's not a huge literature on international spillovers in these G models. So there are some promising avenues that I think that are there in the literature. Papers by Dragana Bergholt at the Norges Bank and Tommy Sveen, who think about intermediate goods trade and heterogeneous producers. Alpanda and Aisun have a paper that look at global banks that generate some financial co-movement, and a paper by Johan Gartz and Conny Olofsson, and Conny is a colleague of mine at the Riksbank, who look at trade in oil as an input. So all of those will generate more co-movement, but when working with this review, this model review, my colleagues realized that it's not very easy to incorporate this in a standard ESG model, but quite complicated. So we're not there yet. As an aside, I thought I'd mention, I mean, when we talk about weak spillovers for international shocks, of course, there are, I think this is also a sign of the fact that it is a challenge to get co-movement right in DSG models also for domestic shocks, that is in closed economy DSG models. And one illustration of that is that in order to generate the co-movement that we have in DSG models, tend to need quite a lot of shocks, which goes in contrast to some empirical evidence, at least, that suggests that business cycle fluctuations in advanced economies can be explained by very few driving forces. Maybe two shocks or one shock can be sufficient to explain co-movement. But DSG models are just simply not able to capture that as it stands. So next, something about forward guidance. This is, of course, a tool that has been increasingly used at central banks. As I said, the Riksbank publishes its forecast of the monetary policy rate. We've been doing this since 2007. We're now also publishing some type of forecast also for our portfolio holdings of bonds from our asset purchases. I mean, there are many reasons to do this, I think. One reason is, of course, to be transparent and to have consistent forecasts. So you want to tell the public what is the policy assumption that you based your other forecasts on. That is only fair. Another reason is, of course, to manage expectations, which is one reason why many central banks are using forward guidance, is to manage expectations of future short rates, for instance. What we have also stressed at the Riksbank that is that by forcing ourselves to think hard about where monetary policy will go in the medium term, not just in the near term, it has improved our discussions internally at the bank and also our communication externally, which I think is an important reason to publish these forecasts. But of course, we all know that there is this puzzle in these G models, which is called the forward guidance puzzle. So the effects of shifting future policy rates in these G models tends to be very large, and it tends also to increase with the horizon, which seems quite unreasonable. This has, of course, spanned a huge area of research, and there are many models now that try to deal with this. Inspired by this work, our own approach currently is to use have a version of our DSG model with discounting, so that future shocks or future expectations matter less than expectation of what will happen in the near term, and also to condition in monetary policy assumptions for the future or a policy rate path with just partly anticipated shocks, so that movements in our future rate future policy rate that are further down as a longer horizon have smaller effects than those in the near term. And I think that, again, that's a pragmatic way to do it. We have used some empirical work to calibrate those weights of the partly anticipated shocks. Still, even if there are all these models around to say how to deal with how to get a more reasonable effects of forward guidance, it's still a challenge to know what is reasonable, because we don't, in my view at least, we don't have a very good view of how the economy today should respond to shifting expectations down the road. So I think there's quite a lot of work that can be done that would be very useful for us. A final point I wanted to make is about asset purchases. So of course, also about asset purchases, many central banks are using these, and also for asset purchases, there's quite a lot of work that has been done, both theoretical work and empirical work. My view is that there's still not that much consensus on how they work. I mean, which channel is most important? There are several channels, and it's hard to tell which is most important. Are the effects of asset purchase time varying, or are they state dependent? Yes, they probably are, because I mean, launching asset purchases in times of financial turbulence will probably have very different effects from launching them in more quiet times. Are the effects asymmetric in the sense that increasing your holdings of financial assets have different effects than decreasing them? Well, very possibly so. So I think one reason why it's so hard to get this consensus is that with asset purchase, we're really moving into, there are many more dimensions of financial markets that matter than for normal traditional monetary policy using short rates. And here economists tend to differ. So in a sense, the devil is in the institutional details. So one example of that is that in contrast to, for example, the US that we just heard about, long-term interest rates do not seem to be particularly important in Sweden. And because households and firms, they tend to borrow at very short maturities. So any framework that focuses on the effects of asset purchases on long-term interest rates and then on spending is probably not appropriate for Sweden. When you think about private asset markets, they could also be very different. They could also work very differently in different countries. So again, that's another dimension that now becomes important for monetary policy, which is tricky to pin down because it might be different in your economy than in others. So this makes it more difficult to assess the transmission mechanism of asset purchases and the effects on the economy, and therefore to fine-tune monetary policy. The approach we're using is to use a calibrated open economy DSG model by Kolacha and Veselovsky, and we calibrate that to make sure that financial market responses match QE announcements. Again, that's one approach. I think there's more work that could be done here. But one issue which is particularly challenging for small central bank with limited resources is that this work may need to be country specific. I think that's a huge challenge for us. So the way forward, just to wrap up, I think there are obviously many challenges. What I wanted to stress that three things that would be really useful to improve our understanding would be the driving forces and propagation of shocks, both within economies but also across economies, about expectations and expectations formation and how shifts in expectations affect the economy today. And finally, how institutional details matter for the monetary transmission, and in particular then of unconventional monetary policy like asset purchases. Thank you.
Thank you. Thank you for the perfect timing. So is there maybe one question, given that we're a bit over time, we can...
May I, Fiorella?
Sure.
Yes. So thanks, Ulf. This was very interesting. I had a question. You mentioned, we all have this issue with forward guidance puzzle, and, I totally agree that the hardest thing is to find what is reasonable in the data. And you mentioned, you use both discounting and partly expectation shocks. You mentioned you sort of calibrated this based on some empirical work. Could you just say a few words on that, elaborate on that a bit?
Sure, sure. No, I think so. So we did some work a few years back when we evaluated the effects of our forward guidance and the effects of publishing our repo rate forecasts, our policy rate forecasts. And one part of this, which has also been done in other economies, is to look at how do market rates respond when we change our published forecast for the policy rate. And by looking at those effects, we can get an idea of at what horizon does changing the policy rate forecast have a bigger effect on market rates. Of course, then unsurprisingly, there are big effects at the short horizon than at long horizons, and we can use those weights and that relationship to calibrate the effects of shifts in forward guidance within our model. So I think that's essentially how we do it.
Thank you. I would move to the last paper, which is by Marc-Andre, who will give us the perspective of Canada.
Hello, everyone. It's a pleasure for me to attend this conference and present the results of our most recent review of monetary policy frameworks, which you've heard a few words about already from Fiorella. And today I want to discuss the role of models as part of this process. So in addition to the usual disclaimer that my talks reflect solely my views, I want to mention that the work I'll be presenting today reflects the contribution of many Bank of Canada staff. I'm happy to provide the key takeaways from this work. So this picture shows the evolution of Canadian inflation over the last century. And you can see the different frameworks that were in place through the years and the changing behavior of inflation over time. Canada adopted an inflation targeting framework in the early 1990s. That's a 2% target with a 1 to 3% control range. And we can see that this regime has been quite successful with the level of and volatility of inflation coming down since then. Now, although IT is a success, we always look for ways to improve our approach. And so as part of this, we conduct a review of policy frameworks every 5 years. And this leads to the renewal of our inflation control agreement with the government. Our most recent reassessment was completed just last December, and so my goal today is to share with you some highlights of our findings. I want to do this in 4 main steps. So first, I just want to discuss a couple of challenges that we were aiming to address in this renewal. Second, I'll tell you how we conducted our assessment and say a few words on the role of models in this context. And then I'll give you highlights of our findings and conclude with the outcome for the choice of regime that's going to be in place for the next 5 years. So the first challenge we're facing is that we're living in a world of lower interest rates. As in many other countries, the neutral rate in Canada has come down over the last decade. And this means that we have less room to lower the policy rate in response to negative shocks. And with stochastic simulations, we find that more likely that monetary policy will reach the effective lower bound in the future. The chart on the left shows that the probability of a binding lower bound rose quite significantly over the last few years, while the chart on the right shows that the projected duration of ELB episodes has also increased. So given this, we asked ourselves which policy regime is best suited to face more frequent encounters with the ELB. The second challenge I want to mention relates to increased labor market uncertainties that can come from structural changes like demographic shifts, globalization, and technological change. And these forces are affecting both the demand and supply of different skill sets, creating job mismatches, and increasing uncertainty around maximum sustainable employment. In addition, how to respond to this higher uncertainty is further complicated by evidence that inflation has become less sensitive to changes in economic conditions. You can see on that chart here that with a flatter Phillips curve, a wider distribution of the output gap can be consistent with inflation at 2%. So what this means is that inflation is less informative about the degree of slack in the economy. So given this, we asked ourselves which policy regime is most flexible to accommodate labor market uncertainties. So against this backdrop, we set out to assess the performance of 6 different policy frameworks: flexible inflation targeting, which is our current regime, average inflation targeting, price level targeting, and employment inflation dual mandate, and nominal GDP level and growth targeting. The regimes were assessed against a broad range of criteria. So in the interest of time, my talk today will focus on aspects related to macro stability, robustness of performance, and understandability. So given the 2 challenges I mentioned, we looked at frameworks that incorporate greater history dependence. A framework is history dependent if it involves a commitment to make up for past deviations from some target variables. If agents understand this commitment, it can shape their expectations and behavior. And this influence is especially beneficial when the policy rate is constrained by the ELB. So this is an important dimension to consider given our first challenge. We also looked at regimes that put a greater weight on or emphasis on stabilization of a real variable to address the issue of labor market uncertainties. Now, a key issue for assessing history-dependent regimes is that their performance depends on the extent to which agents have rational expectations. If expectations are mostly rational and forward-looking, then highly history-dependent frameworks such as PLT tends to perform best due to their influence on inflation expectations. In contrast, if inflation expectations are largely backward-looking, then history dependence can lead to volatility in the real economy. So all this implies that how these expectations are modeled is important for the evaluation of the frameworks, and I'll come back to this point in a minute. So we used various analytical methods to assess the regimes. We assessed macro performance using our terms of trade economic model, TOTEM, which is one of the bank's main models of the Canadian economy. Now, given the importance of expectations I just mentioned, let me just highlight that in TOTEM, about half of firms are rule of thumb price setters, while the rest have forward-looking model-consistent expectations. We complemented the analysis from TOTEM with several purpose-built models to ensure our results were robust to different measure features, such as bounded rationality, accounting for income and wealth distributions, or uninsurable income risk. The bank also conducted laboratory experiments to evaluate people's understanding of the frameworks and public consultations to ask Canadians for their views about the different options. Now, this slide shows results of stochastic simulations for the volatility of key macro variables under different policy frameworks. And there's a few key things we want to take away. The first one is that there's no framework that strictly dominates across all dimensions. FIT, AIT, and the dual mandate emerge as the most robust frameworks in stabilizing the real economy. Second, PLT is slightly better to stabilize inflation, owing to its greater degree of history dependence. But this is because under PLT, inflation expectations increase following a negative demand shock. So this reduces real rates and helps mitigate the severity of the ELB episodes. But this is at the expense of greater macro volatility, as we can see on the chart. Nominal level and growth GDP targeting performs more poorly. For level targeting, this is similar to PLT and relates to the history dependence that becomes destabilizing. Whereas for nominal GDP growth targeting, the poor performance is driven by a policy response that's too aggressive during recovery periods where growth tends to be strong. One of the takeaways from the previous slide is that flexible inflation targeting and average inflation targeting perform similarly in terms of their ability to stabilize the economy and inflation. The chart on the right shows that AIT is most helpful specifically when we're at the ELB. This is because inflation expectations behave similarly to PLT at the ELB. But one of the challenges with AIT is that it can lead to more volatility in the economy when we're not at the ELB. In particular, the need to follow periods of above target inflation with periods of below target inflation means that monetary policy has to engineer a slowdown. So in models with fully rational expectations, a period of short weakness is usually enough because agents anticipate the decline in future inflation and moderate their price and wage increases. In a more realistic setting like totem, agents are not entirely rational, so a more severe slowdown is needed to pull inflation down below target. This leads to a slightly weaker performance, as we can see on the chart on the left. So next, the assessment so far shows that some alternative frameworks have potential benefits at the ELB. And to assess the robustness of our findings, we conducted lab experiments and ran other model simulations as cross-check. Especially, we were interested in testing our assumptions around expectations. So we conducted lab experiments to evaluate people's understanding or ability to forecast inflation and output under different frameworks. And not surprisingly, one of our findings is that the majority of participants depict some form of backward-looking expectations. This slide shows the performance of our policy frameworks in the lab experiments following a shock, bringing rates to the ELB. The result shows that FIT and the dual mandate are the most stabilizing regimes, followed by average inflation targeting. And you can see that the window over which average inflation is defined matters. With longer memory, the performance of AIT deteriorates as it becomes similar to a PLT horizon. With real people in our lab setup, we find that this can become destabilizing. Given our findings from the lab experiments about the role of expectations, we did additional analysis using a model with bounded rationality. And in this model, households and firms over-discount the future when making decisions. So this essentially weakens the expectations channel. And we can see here on the chart that the relative loss of PLT and AIT relative to FIT deteriorates as soon as we depart from rational expectations. This confirms our results regarding the underperformance of highly history-dependent frameworks. So overall, we've gathered some evidence that FIT could be a superior choice to AIT in certain situations. First, at the ELB, the performance of AIT deteriorates relative to FIT when there's a small deviation from rational expectations. We can see this from the lab experiments and the model with bounded rationality. And we also found that when we're not at the ELB, average inflation targeting can lead to greater volatility. So taking together what we've learned from model simulations and lab experiments, we considered whether we could replicate the benefits of AIT at the ELB by complementing FIT with a state contingent forward guidance, where the bank essentially commits to keeping the policy rate for longer than suggested by the reaction function in order to make up for the ELB. This option is shown in blue on this slide, and we can see that during ELB episodes, forward guidance helps flexible inflation targeting deliver a similar macro outcome as average inflation targeting. For inflation, forward guidance generates even slightly better mean outcomes than AIT, while keeping the volatility of inflation and output relatively comparable. So the last aspect I want to mention is the public consultations. This was a new part of our renewal process where we asked Canadians about their views in relation to the different regimes. And the main thing we learned is that low and stable inflation is the most important thing to Canadians. Most respondents support the continued use of inflation targeting and think that the range of 1 to 3% is helpful to deal with different situations and adjust interest rates smoothly. I also want to mention that in terms of the results, the next easiest approach to understand from respondents was dual mandate. But at the same time, they thought that the dual mandate could lead to higher inflation, that it could cause a de-anchoring of expectations, and that an employment objective could politicize monetary policy. So let me conclude with a few lessons from our framework review. First, our model-based simulation suggests that FIT, AIT, and dual mandate are likely to perform better than the alternatives. Neither AIT nor a dual mandate was found to be better than FIT, but the analysis found some value in elements of these two alternatives. With regards to the issue of lower neutral rates, our first challenge, and the role of history dependence to deal with that, we learned that most of the benefits of average inflation targeting are at the ELB. When not at the ELB, plausible departure from rational expectations could generate more volatility. In that context, we found that complementing FIT with a state contingent forward guidance commitment can replicate the benefits of history-dependent policies without changing regime. With regards to labor market uncertainties, our second challenge, our simulations suggest that the differences in performance between dual mandate and FIT are small, suggesting that any gains from a change in framework would be modest. This is because our FIT framework already embeds some elements of a dual mandate. So given these findings, let me just wrap up and give you the outcome of our agreement with the government. In terms of the main aspects of our policy framework, we'll continue to target our 2% and use the range. And we want to emphasize that this range is helpful as we want to actively seek maximum sustainable employment. Now, that said, we've been clear that the inflation target remains our #1 objective. In other words, we'll exploit the flexibility in the range only to the extent that it's consistent with well-anchored expectations. So I'll stop here. Thank you.
Thank you, everybody, the presenters and the questions. Now I would give the floor to Matthieu Darracq Paries from the ECB for the second session.
Thanks a lot, Fiorella. Hi, everyone. And I think we will not lose time. I'm very happy that we could join. And thanks, Ernest, Juha, and Alessandro, also on my side, for being able to put this event together. So I think we are diving now in the concrete of what we need in our models and what we found out. It's also a pleasure to have a session where Juha would have to interact with Jesper and Zhang. And without further ado, I will give you the floor, Juha. Over to you, Juha.
Welcome also from my behalf to this webinar. It has been very interesting already. I wanted to thank SUERF and Ernest and also Dragana for initiating actually to organize this seminar, and of course Alessandro and Matthieu and many other Eurosystem colleagues to help to put the report together. Also want to thank panelists that have been agreed to participate the webinar today. The usual disclaimer, so the views in the presentation are my own and not reflect necessarily the views of the Bank of Finland or the Eurosystem. So my presentation is based on the section 4 of the ECB occasional paper that Alessandro already referred to, and we will particularly look at the assessment of the analytical gaps and the model development needs within the European Central Bank system macroeconomic models. Alessandro already used the same slide to characterize the fact that macro modeling is very much based on this pseudo modeling strategy, which seems to be the case in many other central banks as well. What I think is important from here to realize that there's a large set of models that are used for projections, different types of policy simulations, and also for short-term forecasting. And because the use of these models differ, also certain type of models are preferred over the others. For instance, in projections, these more flexible semi-structural type of models are usually used, while in the policy simulation, we often use the structural DSG type of models. But it's also important to notice that there is a lot of cross-validation, as Alessandro already said. And in the context of the strategy review, we also used very different types of models to analyze or to evaluate the different monetary policy strategies. And just the previous presentation, we just heard the way this was done in Canada, and we used a very similar approach in the Eurosystem. But now the thing is that the models are never ready, as you very well know, and there's a lot of need to improve them continuously. So in the report, in the section 4, we discussed these analytical gaps and the development needs. within these 6 broad categories that you can see on the slides. So we looked into how our models deal with the long-term trends, how they deal with the monetary policy transmission mechanisms, different channels, how the models deals with the interaction with financial and fiscal policies, climate change, large shocks, and also global factors and international spillovers. The previous presenters have already alluded to many of these issues that have been raised also in the respective institutions. So our purpose and the sort of the mandate and the task was indeed to evaluate our current models, and sort of the roadmap, the way we did it was that we first look at the current practice within the Eurosystem, central banks in the context of these 6 broad categories. And then we used a lot of information that we got from the survey that was done at the beginning of the process, and it was very important to get the current, to understand what is the current practice. Then we aim to, say, roughly speaking, to assess the distance of our modeling practices to academic frontier or the other institutions' practices, and then finally draw the conclusions and recommendations or the actions which should be taken to improve the models. We also draw broad conclusions on the priorities, and then in this context try to take into account the policy importance and also acknowledge the resource and the feasibility constraints. Importantly, also this overall assessment differed across the different type of models, and also whether it was suitable to adapt the current models or engage in the new model development. So in our assessment, we provide a list of priorities, recommendations, and literature benchmarks with respect to, on the one hand, trying to adapt the current semi-structural models that we use, or the structural models, and then also with respect to development of the new models. In this slide, you can see a bit more specifically the issues we looked into each of these key topics. This is just to highlight that we try to be as comprehensive as possible. And you can see there's a lot of topics, and that explains also why our report is so long. But what I will do next is that I will give you an overview of the recommendations, and I start from the semi-structural models. So this is very much a bird's eye view. I won't go into very much into details. So for the semi-structural models and for the long-term trends. So it turns out that the main macroeconomic models, or the semi-structural models that we use routinely in projections and sometimes also policy simulations, they typically treat the long-term trends as exogenous, or sometimes ignore them altogether. But we know that the demographics, low productivity, and falling interest rates, natural rates, are typical examples which should be featured more prominently in our business cycle models. Probably the focus on the business cycle frequency is the reason why we pay less attention to these trends. Then, as for monetary policy transmission, we highlighted the importance of these alternative expectation formation mechanisms, and also accounting for different transmission channels of non-standard measures. Fabian just actually provided some insight in the US, how they deal with different assumptions on expectations. So it's very useful. In the Eurosystem, we actually had a specific task force looking into the similar issues. And for example, at the moment, Banque de France and the ECB also already done this or in the progress of allowing different to simulate these large semi-structural models to under different expectation formation mechanisms. We also find out, as many others presenters previous, that to work further on the non-standard measures. When we did the survey, we found out that about half of the projection and the policy models in the Eurosystem can account for the non-standard measures, either as, say, fully specified block in the model or using satellite models to, say, to inform of the impact of, say, asset purchases on the interest rates, and then feed in these paths on the bigger models. The semi-structural models could also be developed further to account for more granular types of fiscal instrument. And in this context, we particularly found out it useful to look into experience from the COVID-19 pandemic, NGEU, and also obviously in the future of the climate change related policies. We also note in the report that the Eurosystem has actually devoted a considerable amount of analytical work on the fiscal policy and also on the interaction of fiscal and monetary policies. And then finally on the climate change, again, when we did the review, we found out that climate change and the related policies are largely absent from the main Eurosystem models that are used. But we know that the economic literature is progressing very fast on this, and there are a lot of relevant directions for further developments. And I think that's what obviously the Eurosystem should also follow. And we know there's already work going on in this area. In this specific context, we emphasized the importance of modeling the key transition channels of climate change to inflation and growth, and also acknowledging the importance of energy sector and the impact of policy transition policies and instruments, which should be highlighted in the models. Then what about the structural models? Here we again emphasize the long-term trends issue, especially when it comes to potential growth drivers and the natural rate. Now, because these structural models are typically used in the policy simulation, we find it important to also allow for simulation and or estimation under different assumption and expectation formation. We heard again a lot about this today, and also possibly allowing for learning mechanisms and imperfect common knowledge. Fabian's presentation again was very interesting in this context. I mean, the idea here is simply to to understand the mechanisms better and try to robustify the possible policy recommendations that are coming out from the policy simulations. I mean, also when it comes to non-standard measure, also in the context of structural models, we found it important to incorporate and understand better the non-standard measures, the transmission channels, also in the context of structural models. We also find it important to attempt to validate empirically these different transmission channels. Ulf just referred to the same issue in the context of the Riksbank. Then finally, when it comes to, again, related to monetary policy transmission, one important feature is are the nonlinearities. As you probably know, it's very common practice to simulate the structural models in a linearized or log linearized form, even if we know that there are many important nonlinearities present, and that can impact importantly on the policy and also on the shock transmission. The models that we use at the Eurosystem routinely they have been developed towards that goal of allowing for these nonlinearities, but there are still a lot to work on this area. And we also note in the report that the literature now provides a lot of new and efficient tools to allow these nonlinearities, even in the larger models, and we should aim at adopting these to our frameworks as well. Now, what about the development of the new models? Here, I think there are few areas also, and one area is related to monetary policy transition and is related to heterogeneity. Here we recommend that we should focus when it comes to developing indeed the new models on household and labor market heterogeneities, and again the empirical validation of models such as Zhang. Again, there's a lot of Eurosystem research going on this at the moment, and a lot of good academic benchmarks to which we can also build. We also recommend to explore further the different type of nonlinearities in this context, possibly in a small and stylized structural models that allow more complicated actions between different nonlinearities that give rise because, for instance, zero lower bound or borrowing constraints or collateral constraints. We think that this can be very useful to make the cost-benefit analysis of the non-standard measures, but also highlight the interactions with other policies, such as macroprudential policies. And finally, there's obviously a need to develop new models which feature climate change more prominently, and we are emphasizing here particularly the role of the energy sector, understanding and modeling the micro foundations of the relevant externalities, the nature of the disturbances coming from the climate change, the global dimension, and the role of mitigation policies. So that's about the quick overview of this assessment and the recommendations. Matthieu, how much I have time left?
I think it's okay. You can finish your slides. Then we can pull perhaps comments at the end. So I think, yeah, go for it.
Thanks. So I thought to take two very quick examples, which are based on the analysis that we did in the context of this report, just to highlight two things. So one thing I wanted to highlight is the role of, say, long-term factors, or in this particular case, the endogenous total factor productivity. So on the left-hand side, you can see the impulse response to typical demand shock in the models that either feature or does not feature the endogenous total factor productivity. What you can see here is that if you allow endogenous total factor productivity in the spirit of, say, endogenous growth models, you can see that the similar sized demand shock generates a substantially higher degree of business cycle persistence with a more pronounced and long-lasting effects to real side of the economy, and to some extent also on the nominal side. And the main mechanism here is that there is a spillover in the endogenous TFP case from the weak aggregate demand to technology growth, and this is something that is obviously absent in the standard macro frameworks that are based on the exogenous growth theory. In the report, we also show that this you can call the hysteresis effect are actually substantially amplified if you allow for or if you account for the zero lower bound of monetary policy. The second example is related to the previous presentation. He also looked different monetary policy strategies and also about the expectations. So this just highlights basically two things. Highlights the fact that depending on monetary policy strategies, the impact of demand shock on inflation can be very different, but it also depends a lot on what we assume about the expectations formation. So maybe two main conclusions coming from this. So on the left-hand side, you can see the simulation of models with different strategies, or one model with different strategies and different assumption of expectations. So if you allow for partly backward-looking expectations, you can see that they prolong the impact of negative demand shocks on inflation, actually under all the monetary policy strategies in this case. But then if you allow for different or use a different monetary policy strategies, such as average inflation targeting or the price level targeting, you can see that it can effectively mitigate the negative impact of policy shock, of the demand shock on inflation due to the expected reversal in future inflation. And this is the case even if the expectations are fully forward-looking. So this again highlights the importance of simulating these structural models, particularly under different assumptions on what the policy reaction functions are and what we assume about the expectations. So that's all from my side. Thank you very much, and to you, Matthieu.
Thanks a lot, Juha. So I think I would give now the floor to Jesper Lindé from the IMF.
Thank you very much, everyone, for joining, and then, of course, also to the organizers for inviting me to present us this very interesting workshop. For those of you who doesn't know me, my name is Jesper Lindé, and prior to joining the IMF, I worked at the Swedish Riksbank and the Federal Reserve Board. Now at the IMF, I lead a newly created monetary modeling unit in the IMF's Monetary and Capital Markets Department, MCM. You can see that from the first slide to the left. Now my team, so you might wonder what I'm doing here in this panel, but my team is working on constructing structural monetary macro models for forecasting scenario design to be used by Article 4 teams and by countries who are interested in model support. So we're very much into sort of the model development business and face many similar challenges in this respect as been discussed to other central banks. And of course, the usual disclaimer applies. So, the task was to talk about some model development needs, and this is a very big topic, of course, as I think Juha's presentation highlighted, and also the previous speaker. So I was just thinking I'm going to focus on DSG models that's given from the outset and talk about four issues that I think are very sort of important when sort of trying to design DSG models today that could be useful in monetary policy analysis. And the first is the forward guidance puzzle. The second is Phillips curve and expectations formation. The third is how to think about UMP tools in this model, and then wrap up with open economy issues. I actually think that some of these issues, or basically all of them, had already been discussed at length. But let me see if I can complement and give some perspectives on the issues. All right, so macro modelers at central bank, I think we sort of agree now that the forward guidance needs to be the forward guidance puzzle needs to be addressed somehow. And I think there is a growing literature studies alternative ways to do so. We have Gabbay's discounting, we have Woodford's short-term planning horizons, and so there are ways you can think about flatter slope of the Phillips curve, lower interest sensitivity of demand. So there are a number of ways. But I think here, which would be interesting to get people's views on this is, what are the policy implications then of these alternative approaches? And I did one paper, a recent paper with my supervisor Chris Urseg and Sultan Jakob, where we sort of looked at basically a simplified variance Gabay's approach. So you deviate from rational expectations in a model and not too much, I would say it's a modest deviation from RE, but still that's sort of small. I would think about it as a small deviation from RE. That still really offers an alternative interpretation of the de Bortoli-Galli evidence that basically the output and inflation cost of CLB can easily become very modest, when you do these tweaks, at least with this Gabay approach, it seems like. So there it seemed to me that, I think Ulf highlighted that too, and that the balance between sort of fixing the forward guidance puzzle and the policy implications are delicate. So let me just show you a couple of figures. So we look at this is a given, we do like a conditional forecast with the model. This is a variant of it's Smetz-Wouters model. So it's a model we all know. And we look at this forecast distribution given the state in early or late 2020. And we then make a projection, and we have like an estimated rule where we just take out the output growth term, because with the output growth term, you tend to want to lift off as soon as output growth start to rebound. And we figure that that is not really sort of plausible. So we set that to 0. But this is sort of FIT, flexible inflation target. This is temporary AIT. Still just having the estimated inflation response coefficient. This is a more aggressive AIT where you care more about the AIT gap. So you're going to respond more vigorously to the AIT gap. And the final column is temporary PLT. And you see from these rational expectations versions, right, that when you move along this sort of increasingly more history-dependent policies, you get noticeable improvements in the output gap distribution, both moderating downside risk and improving the modal outlook. Now I just introduced discounting in the demand block. So actually there is the Phillips curve, the wage and price Phillips curve is exactly the same. I just move in a tad of discounting in the demand block, in the consumption oil equation, in the investment Tobin's Q equation, right? And then you rerun things, and then you see that things are moving in the same direction, right? But clearly moving less so. And this is not by this. I'm not going as far as Gabay. He did like 0.9, or 0.85. He did like massive. This is just like basically 0.97 or something like that. So if it's 1, it's rational expectation. This is 0.97. If you want to think about a Steinson's parameter. Okay, now we showed in the appendix, when we do discounting in both supply and demand, sort of basing both demand and pricing block with the same parameter. And then what you see then is basically that you don't improve. In this case, there's hardly any improvement at all, right? You basically don't get much traction out of these alternative policy frameworks. So I think that was so I was really want to stress that the way we sort of address the forward guidance and really can matter a great deal. And here you would say it moderates the benefits of alternative frameworks, but of course the flip side of this is that it would also make the CLB become much less relevant. So in a way, this is an alternative interpretation of the Galli-de Bortoli. The Galli-de Bortoli punchline was that the Fed did exactly as much unconventional policies to offset the adverse effects of a binding ELB, but another, this model with discounting in both demand and pricing blocks, offers the possible interpretation. Well, the CLB doesn't matter that much. If you really only care about the near term, then that you're long-lived liquidity trap doesn't really matter that much. So I would be curious to sort of get people's reactions on how to move this forward in the best productive way. It seems like our models are really on a sort of ridge there. Okay, the other point I wanted to make is, what are the implications now of thinking about the current inflation, the surge in inflation in the US in terms of our baseline Phillips curve. So the baseline Phillips curve that we have from the sort of a standard models, I think this is again using the Smets and Wouters model, but I think this is new area wide model. There, I think in most models this is true, that the estimated slope of the Phillips curve measures as this kappa MC multiplying marginal cost is very low, and I thought most of us thought it had actually flattened following the Great Recession. That you had a certain slope pre-GFC, became even flatter pre-COVID. But interesting now, and also the other point is that it's highly forward-looking. Like the degree of dynamic indexation is low, so it's a highly forward-looking Phillips curve that provided the sort of the best adaptation to data. But of course, now if you extend the sample and just include the COVID episode and until today, when you have a bit in surge, you actually see some tendencies of increased dynamic indexation and a steeper slope again. Now, so although now you would say that estimates now move in the sort of expected direction, I would say when extending the sample, it is challenging now to reconcile a standard forward-looking flat slope Phillips curve with the recent surge in US core inflation. And just an example then to show you how that would look like in the Smets and Wouters. So this would run the model from 1985 to 2021 Q4. And here you have the recent ticks. This is annual rates around assuming that the Fed has a 2% target here. So what the model will suggest is that, which is sensible, that expansion monetary policy, that is this purple part, that is accounting for some increasingly sort of share or the uptick in core PCE. You also have the price markup shocks and wage markup shocks. That's the British green and yellow. So they are key, right? That's not totally surprising either. What is more surprising is that this government spending, like fiscal policy, it's nothing, no? And it cannot do it cannot do much in this model because the Phillips curve is so flat, and so those shocks cannot really matter much here. Now it's actually a slight negative contribution. But and implicitly, so that this, as you know, Smets and Wouters doesn't feature government spending as an observable directly, but it sort of implicitly, because it's a closed economy model, and you have both output, consumption, and investment as observables, the model should filter out that that's part of what's going on. Still, you don't get much of contribution. Because of course they would not be able to count much, and so that's one part, I think. And then there's also, of course, the role of inflation expectations, where in our models inflation expectations are generally well anchored around the central bank's target. It's sort of by autopilot on the central bank in our models is assumed to do its job, and of course if you do your job and you do your communication, you make sure inflation expectations are well anchored, and so I think we all agree that this is a generally nice feature. Now I still think there is an issue if we want to have this by autopilot in our models, because then it might be that our policy, our projections are always contingent on a firm commitment to price stability in the central bank's communications. Implicitly, that's what we assume, that they always in communication, the policymakers, they always talk the talk of the price stability objective, because we've always anchored medium and long run expectations in our model. And I mean, you can see this in sort of rolling forecast of the Smets and Wouters here for this core PC. There is a little bit of it's always mean reverting, right? So you cannot, because inflation expectations are well anchored. Although I would say at the end, it doesn't go back so quickly to 2%. So there is some sustained inflationary pressure still, but the model can never give you would never predict a persistent rise in inflation. And I think this is, for us as modelers, is interesting to think about sort of persistent energy price, large energy price shocks, if they should be able to move expectations more persistently, and the distinction between household and market expectations amid large energy price shock. So, all right. So I was some shameless promotion here of my own work, recent work, but you know, I just want to point out that is one feature, of course, that we can think about is that we always tend to work with linearized models, and that's, you know, very convenient. You know, all the Kalman filtering, especially if we are in a forecasting environment, that is very convenient. Now, I just want to point out that, for instance, the basic Smets-and-Wouters model that I used here actually implies sort of banana-shaped Phillips curves, which means that when the output gap closes or the economy can start running hot, the slope of the Phillips curve shifts up endogenously if the model is not linearized, if you have a sufficient amount of real rigidities in the form of the Kimball aggregator in the model. So that it, you know, it's that inflation can be more sensitive to economic news when the economy is operating above potential than when the economy is operating below potential, which you could argue was the case for some years after the global financial crisis. But still, I don't think this feature will not be enough. You have to have a very large degree of a large degree of this real rigidities for this to sort of work out quantitatively. But you know, it's a step in the right direction, but I still think that presses the issues to think about possible nonlinearities. All right, then UMP, which I think is there's an increasing, I think, you know, the previous speakers, you talked about the low R-star environment, and that UMP tools might become more routinely used to provide macroeconomic stabilization and keep inflation close to target. And here I think that following up on what Ulf talked, I mean, it's very important that we need to establish sort of benchmark framework to think about UMP tools. And I think it's also important that those models that we formulate as benchmark tool should be able to motivate why UMP tools are needed. And here I think not mainly necessarily, not for sort of ensuring financial stability, but say for boosting the recovery. So we use UMP to improve the economic outlook. I mean, we should have my thinking here that we should have models where forward guidance is not enough, because I presume if actually forward guidance was enough, then why not mostly rely on that, and why would you have to resort to QE? So it's I think ideal would be a framework where forward guidance cannot really do the trick, and that's why you shift to QE. I think also when you come into this and you think about that we might have to more routinely rely on these unconventional tools, then I think, I mean, we normally have a model where we have a rule for the short-term policy rate. This could be either the form of a loss function or a simple rule. And then I presume what the standard is right now is that then you think about LSAPs as sort of like an exogenous discretionary instrument that you know, deploy as necessary. But I was, you know, this is, I think, been a little bit of a problem in terms of policy communication. Somehow UMP, when the central bank, how big asset purchase is sort of secretive, so it's harder for central banks to be transparent about UMP tools and how you sort of have a rules-based thinking about these tools than communicate rules-based thinking for the short-term policy rate, which I think a number of central banks has now moved to you know, publishing their interest rate forecast. And so I think that to think about rules, you know, the criterion for when you do large-scale asset purchases in our models and have that sort of communication with policymakers is important. And let me, in this context, very briefly, I'm thinking I'm sort of done, mention a perennial question, which I think is is important in this context, how to best model central bank behavior and the merits of simple rules, which is often used, versus loss function based approaches. I think both the global financial crisis and the COVID has shown that sometimes it's very hard to just work with simple rules, and loss functions have advantages. And that is another discussion I think that is important to have. Just finally, let me just reiterate one point of Ulf made, which I think is a very important for small open economies, both advanced and emerging market, that spillovers are really important. And how do we account for how can we better account for spillovers in our models? And I just want to make the point that this is certainly an important issue for Sweden. And you see that Sweden, both inflation, I think today in the current context of where a lot of central banks are sitting there wondering, will we see how much of the high US inflation will transmit into our economies? And that, in Sweden, euro area, you have 0.44. If I was a Canadian policymaker, I might be even more concerned, where you have very substantial correlation, inflation, and not the least for GDP growth, very high correlations year over year, and also of course for policy rates, the correlations are very high. Both say these are two classical examples, and just complementing that to say, it's not only that you have high correlation, say for Sweden, like around 0.8, it's also quantitatively important impact. So when, suppose you revise up your GDP growth, say 1%, normally that transmits to over unity response of Swedish GDP growth. So it's a very significant beta that you have, say, and I think the same is most likely true for US Canada. So it's not just high correlation, it's really a strong co-movement. So those were some thoughts from my end. I mean, I think many other issues have been brought up, like heterogeneity, and this is really just a sort of little sniff test on sort of thinking about simpler models for monetary policy and sort of in a standard way. Thank you.
Thanks a lot, Jesper. Thanks a lot, Jesper, for this nice zoom on what we could do on DSG. And so they are part of the toolkit. They can be improved, but not everything can be fixed. So I think it's good that we complete the picture with the presentation from now Zhang from Bank of Canada. So Yang, the floor is yours. Thanks a lot.
So it's really with great honor to be part of this discussion, and thanks to the organizers for the opportunity. My talk today really echoes many lines that have been already identified by the fellow speakers in early sessions. So my goal is really to give you a bit Canadian flavor of the challenges we are facing and share some aspirations for our developments. So usual disclaimer, these are my views and no responsibility should be attributed to the Bank of Canada. In Canada, we have a long-standing tradition of developing and using models to inform monetary policy. The bank began its modeling in the 1960s. At the time, we relied on a bottom-up approach where the models contain considerable details. Introducing early 90s, the quarterly projection model known as QPM was instrumental in supporting the success of inflation targeting regime in its early phase. The first version of our DSG model, Totem, was introduced in 2005. Its key strength is to address terms of trade shocks. Totem has been enhanced over the years. In particular, in 2012, we have introduced features to allow the implementation of forward guidance and quantitative easing. In the latest update, this model was also further enhanced to help better deal with the implication for monetary policy when we have highly indebted households. A large-scale semi-structural model, Lens, was added in 2015. Lens is tied more closely to the data than Totem, but has a smaller dose of economic theory. It is also very flexible to operate. These models are considered very good complements. So as you can see, generational model change is infrequent. It occurs when new economic challenge meets advancing economic theory. So there's no doubt that our current generational models are well tested in more complex economic environments. So, on top of my mind, there are 4 key challenges I see Canadian model development needs to address. First, how to enrich our models to capture monetary transmission in face of household heterogeneity. Next, could our model reflect how real people think, behave in normal times, and more importantly, in times of stress? One good lesson that the pandemic has taught us is that economists have a lot to learn from general science. When the world is experiencing supply chain disruption and geopolitical uncertainty, we're wondering if network models and complex science can offer some new insights. Lastly, to support long-term growth and social good, macro models may need to be expanded into longer horizon to assess macro impact of falling R* and climate change. This all offer new challenges to our modeling toolkits. So let's start off by taking a quick look at the Canadian household balance sheet. On the left side, we can see the level of household indebtedness has steadily risen over the inflation targeting period. Among collateralized household debt, residential mortgages, shown by the yellow area, accounts for majority of the debt stock. At the same time, we notice that home equity withdrawal is key in driving the increase in Canadian household indebtedness. So why does that matter? On the right side, we simulate policy tightening case and compare the response of consumption under a high debt and low debt economy. It's clear to see that high debt amplifies the impact of monetary policy when housing is used as collateral asset. We know from Canadian microdata that following the recovery of from the pandemic, Canadian household balance sheet has improved. In addition, there is increased use of variable rate mortgages and HELOC. This may further influence the amplification effect. So to better understand monetary policy transmission in the post-pandemic world, we really need to develop better tools to understand household heterogeneity. We have already some modest amount of household heterogeneity in our current DSG models. For example, we study borrowers and savers and hand-to-mouth households. But despite of this enriched model features, our model can't fully explain consumption data, particularly in recent years. Clearly, there exist some modeling gaps. First, in our current models, the share of borrowers and savers is fixed over business cycle. We are therefore limited to speak to the intensive margin impact of monetary policy. We also know that as policy rates increase, there could possibly be less likely first-time home buyers entering the market. This indicates that monetary policy may also have some potential impact on the extensive margin over the business cycle. Our current model lacks this feature. In addition, we also need to have more capacity to better capture the distributional implication of monetary policy, as well as the interaction between monetary policy and financial vulnerabilities. I will show an example on the next slide to speak to this point. So here I use an example from recent bank research with a Hank model to show how household heterogeneity is highly relevant for financial vulnerability. We plot the simulated debt to service ratio distribution for 2 types of households who differ in their home ownership status. The left are mortgage holders and the right are renters. So these people's DSR distribution prior to the pandemic is plotted in blue, and the distribution in late 2020 is plotted in red. In each figure, we use a dashed line to define a DSR threshold of 40% according to past bank research. So a borrower would be considered as financially vulnerable if their debt service ratio exceeds this threshold. There are 2 key takeaways when we look at this figure. The first is we can tell from the distribution is that homeowners with mortgages experience greater debt obligation, and therefore their DSR ratio on average has risen more than those of renters. The second observation is that within each type of household, income heterogeneity also matters a lot. For example, regardless of the home ownership status, we see a more sharp increase in financial vulnerability for low-income renters and high-income mortgage holders. This kind of analysis, where we can incorporate richer household heterogeneity, can be very informative when we study the monetary policy transmission. The second area we need to devote more effort is modeling realistic expectation formation. Many have speak extensively on this topic, so I will be quite brief. Just go direct to the gaps that we see. Much more progress we really need to make is to catch up with the literature. For example, we know that more realistic expectation mechanisms tend to improve the empirical performance of our operational macro models. However, the limitation is that a lot of this literature usually focus on small scale models. What's needed next is really to start validating these ideas in some of our medium to large scale policy models. We also need models that could better match survey expectation data. Here, I'd like to show a couple of relevant findings from the Canadian survey and model simulations. The chart on the left-hand side shows an interesting result from Canadian survey of consumer expectation on house prices. When we ask, when the respondents are given the information about the past change of house prices, they quickly start revising their expectation of house prices in an extrapolative manner. Recently, our bank researchers have also studied that similar extrapolative behavior could exist in inflation expectation formation process. So for example, at the EOB, more extrapolation of inflation could lead to prolonged EOB episode and may generate deflationary spirals. This type of new perspective would be very helpful for us when we start follow closely and model inflation dynamics. The third challenge we are facing is a global one. Since the onset of the pandemic, we have heard many versions of stories about supply chain. Recent inflation data have also intensified discussion. So what's unique about the supply chain is that it's based on network. At the bank, we have made some progress in developing this line of models. On the left side of the slide, we use a network chart to illustrate the importance of the sectoral interdependence in Canadian economy. The width of the network is measured by the actual volume of input-output between sectors. So clearly we can see that commodity sector, here we plot in blue, crucial input for manufacturing sector production. On the other hand, manufacturing sector, here plotted in green, supply critical inputs for other sectors. So one could imagine when there's a bottleneck in the manufacturing sector, there could be potentially radiating effects to the whole economy. To quickly give an example of how network models could help us think about price and inflation, we simulate a COVID scenario for Canada in early 2020 using a recently developed agent-based model. From top to the bottom, we present 3 snapshots of simulated producer price distribution over time. Clearly, there was a lot of price dispersion shortly after the initial lockdown in Canada for all sectors. It's interesting to see that for manufacturing sector that's plotted in green, price dispersion has been alleviated since 2020. We can possibly credit this shift to a significant growth of online market where there's reduced search costs for households for price and product features. In contrast, if we look at the retail trade that is in orange and the transportation and warehouse sector in yellow, we can see that there's still significant price dispersion, even persisting till the end of 2021. So this kind of information is quite useful as we understand the implication of supply chain disruption from a sector's perspective. The last challenge that I'd like to briefly discuss is related to developing models to address some long-run trend issues. Two particular examples, as many have mentioned, it would be how to improve the estimation of neutral rate, and second, related to how to assess the macro impact from various climate policies. Earlier, Juha has provided already a very rich example on the long-term endogenous growth. So in the interest of time, I will be very brief and discuss some of our work around the climate topic. So we have recently developed a set of global climate transition scenarios to capture a range of risk outcomes for Canadian economy and its financial system. So to develop these scenarios, we use a suite of models approach. This diagram shows the general structure. We recognize there is strength and weakness of different type of models. We learned that how to utilize the comparative advantage of each model to help design the scenario would be the right first step. So on the left, the first component of the model is built upon MIT's EPA model. EPA provides important information about the sector restructuring along the transition. Then the scenario will shift information to focus on United States and Canada from two of our in-house models, BogGenFin and Totem. So both models are DSG on the DSG framework. The supply side of both models are quite rich. We have dedicated raw material sectors responsible for producing commodities and a variety of intermediate goods feeding commodities into the production of final goods. So this type of detailed supply structure really help us utilize the model as useful test beds for studying the macro effects of a variety of climate policies. So climate change don't seem to be remote problems anymore. Flood, wildfire could continue testing our supply chain resilience. So to achieve our monetary policy objective in this new environment, as modelers, we do feel a sense of urgency to improve our tools to meet the demand of policymakers. I'm looking at the time. I think I'm just going to conclude here to recap some of our priorities. First, we want to ensure monetary policy transmission in face of a different variety of household heterogeneity in normal times, and particularly during time of large economic shocks for Canadian economy. To anchor inflation expectation, we also need to have better understanding of how real people behave and try to model their behavior into our models. Lastly, transition risks are of particular significance for Canada, given our endowment of carbon-intensive commodities. So in order to facilitate long-run growth and favorable climate outcome, we could consider utilizing global network models that look into longer horizon. I think I will stop here. I want to thank the organizers again, and we really enjoyed the conference and the workshop, and we hope to have more exchange like this soon. Thank you. Back to you, Matthieu.
Thanks a lot, Zhang, and we take your offer seriously. We should talk about that. It's very interesting. I suggested also to Ernest, we could actually even push further the full Q&A to the end of the presentations. The only perhaps room I open, except if Fabian is okay to postpone. Fabian, you had one question. You want to put it there, or we can move on?
As you like. I can ask now or later.
Yeah, please. Let's take your question and then we move on.
Okay, sure. Thanks. I mean, first of all, thank you. This great, absolutely fantastic presentations. I just wanted to raise another point and get your feedback at this point or later about something that wasn't on these slides, which is about model uncertainty. I think one of the themes that has emerged from all of this is, right, that there's so much about the economy we don't know. We don't know whether the Phillips curve's flat or not, whether expectations are rational or not, whether QE works or not, and we won't find out anytime soon, really, right? And well, very likely. So how can we actually deal with that in our policy analysis? That'd be something that I'd like to put on the table.
I guess that's addressing to me or to the panel.
Any of the three, or we you are, yeah, Jesper and you are, if you have any views on that, yeah.
Maybe I can give a start. I think, you know, as the first session, lots of exercise have shown from different institutions. I think we perform the analysis around the regime using stochastic simulation. I think to some extent we already capture shock uncertainty, and I think, you know, for models that estimate following Bayesian estimate, we do know there's also some degree in terms of model misspecification, uncertainty into that parameter dimension. But I think you're right. You know, we're limited by the horizon where we look at things, and there's a lot more. And particularly, I do see from the expectation formation process, I think introducing learning and then think about how behavior can, you know, enhance our model specification. I think that's very important dimension.
Maybe I can just quickly add to that. It's a very relevant question, obviously, and I guess we know quite well how to deal with say shock uncertainty, and we use that, you know, routinely when we do forecasting or policy simulation in general. But the challenge, I think, is to really deal with the general model uncertainty, which can incorporate the uncertainty over the parameters, or even the uncertainty over the, say, reaction function of the central bank, or the how the agents are learning, or even the regime changes. And I think there we have a long way to go to be able to cope with that type of uncertainties. I guess the one way to deal with some of these is as we have already, and many have already shown, is to make sort of policy scenarios based on different assumptions about, say, parameters or policy reaction functions or the agent's behavior, and illustrate which channels, which type of uncertainties are more important than the others. That's already quite informative for policymakers. Thanks.
I just want to add 1 cent. So I fully agree with both Zhang and Juha's comments. Just wanted to point out that, you know, in the simple Smith-Wouters model that I estimated, actually the log margin likelihood of that model, if you work with discounting or the RE version, is not very different, right? So the macro data can't really separate, you know, in a sense. Fabian, if you draw uncertainty bands about the effect of, you know, the effectiveness of forward guidance, it would be very wide, no? So that's sort of confirming your, or sort of stressing the point you're making.
Thanks a lot to all. So perhaps Alessandro, I give you.
Sure. Well, thanks a lot. Thanks, everyone. So we are ready to start our first and last session, which is about how to improve the use of models for monetary policy. Without further ado, let's start with the first presentation. That's by Matthieu from the ECB. Matthieu, the floor is yours.
Thanks a lot. There is a final leg in our collective work after where we stand, that how to change the model. Is actually, should we look at how we use the model for policy purposes? And without spending too much introduction on that, let me remind you how we went about it. So first, the typology of what we do with models, as explained in the first part with Alessandro, I think they are slashed into bringing an economic narrative to the policy discussion. We also do, let's say, prospective analysis, so it's forecasting in either, but not fully in the statistical sense, but still with statistical objects. It's about risk analysis, which have a model counterpart. It's also how we evaluate policy in this context and how it interacts perhaps with the model robustness. And it's also how we go even beyond, how we make conjecture about far ahead impact, sometimes beyond what could be a statistical performance on statistical ground, let's say. So on all these type of business case on how we use models, we try to have again the same introspection of what could be improved with the model we have, with the model we should have, and what pays off most. We cannot do everything with all models, and one model cannot do everything, vice versa. So it's really about getting the proper trade-off right. So let me right away get to the line of assessment we come up with. So first, on the economic narrative. Economic narrative was found to us as a key object that models should deliver. It's about what drives the economy, where is policy in the drivers of the economy, and what it implies for either the future or policy conduct. And there you will see, I think, one key element we wanted to put forward is to level up perhaps our very large semi-structural models, which you have seen from our stock taking is still the backbone of most of the jurisdictions, central banks forecasting tools, to lift up a bit the structural underpinning and structural narrative. Because what this is, let me just show you a typical use we do with DSGs. No? So DSG have a large part in our toolkit for us, across the globe, across institutions. And Jesper showed all the benefits we can take from it, even going forward if we fix some things. So we can take some narrative. These are just show decomposition from the new AWM, which is one of the key DSG maintained at the ECB, explaining a bit. So it's a 1 year old. So nothing I would say today with the use case applies with current views of the euro area or stance. So just to remind you, it's one example of how you could see economic developments with some narratives. So here you can see a bit some post-mortem of the COVID-related pandemic shock to the euro area, this breakdown about supply, demands, how much of international knock-on effect. So that's a typical thing we do with ESGs. Are we doing exactly the same with semi-structural models? I think we are coming around with areas for improvements that to me would be quite fruitful. The second line has to do with the projections per se. So in the projection environments, when you feed decision bodies with forecasts, as Ernest introduced at the beginning, we can sometimes call that projections. They are most likely scenarios under a certain amount of assumptions, model, let's say, adjustments and judgment. So I think the call we are making is to perhaps share best practices on the conceptual framework and the step that could preside upon providing model-based projections and notion of what could mean expert judgment towards decision bodies. So I think one skeleton of the decision to be made that we didn't put it like that in the report, but that's more or less the summary, is like operating even the best model would still require adjustments. Some could be called judgments, some could be called just simulation modalities. I think what matters most is that we drive the proper line and we make transparent how we conduct a model-based input. So I think this is just a sketch on actually our judgments may always be put by the modelers, but sometimes we do have assumptions. So creating model-based projections is an artistic mixture about fully statistical protocol. We have different type of exogenous and assumptions. We have short-term instruments. We interact the core models with a lot of statistical tools to anchor the short run. We make some also anchoring on low frequency properties, so medium-term issues, which are also from satellite models. And at each of these steps, some other type of judgment may be introduced. And afterwards, we just let the model run on different, let's say, statistical concepts, like conditional projections or other type of expectation management in the computational methods. So that's a bit the roadmap. And of course, the question is whether we can have more leeway for model-based projections to reach the decision bodies in a way that could be a bit more explicit and authentic on the judgment that is behind it. And I think I don't need to show the next one, but just to answer on the model robustness, a key element of this type of activities is to see how different models behave, and because different model classes have different properties. So if we tier too much one model for one policy use, we may actually risk overlooking a key areas of robustness. The third layer is to risk analysis. So projections are mere numbers. I think we are much more to give from our models towards decision bodies through risk analysis in some sense. So in a density, or let's say in a predictive density realm, I think what we advocate is also to batch the core models with a set of well-targeted satellite time series tools. So one thing is to drive a bit the most likely scenario, being very economics oriented about what it means, how it's driven, and how it could change. And the question is whether we can have better statistical metric on the distribution around it. And for that, once you have a bit the satellite tools, questions still remain on how actually they should be interacted with the core models. So when it comes to the Eurosystem projections, we also have ways to survey a bit the expertise, and we have internal surveys on risk. I think the question is to balance such type of expert views on subjective, let's say, risk metric with something which is more model-based. It's also a way also to attract, I would say, flourishing literature on perhaps time variations in different risk metrics or the growth at risk literature and so on. And so you will see now, perhaps I would, in sake of time, just skip that, but you can find in the report some example of this, no? So how to deal with large shocks like the COVID was, and I think it's should be a living set of tools that are connected to the core models that could inform the predictive densities and risk metric around the central scenarios. So the last part, I think, on the model-based analysis for risk is also how we use scenarios. If there is something we would take from the COVID period for the prospective use of models, is like we are far from scrapping scenario analysis. I think so. The COVID pandemic in its onset has been something where models have been called upon actually to formulate contingencies of view of the world beyond any type of statistical measurements. So what happens when you're confronted with something which is just not even in your sample? So I think there it's key to organize scenarios. And I think in the Eurosystem, I will just flesh out, and we have examples in this OP, in the occasional paper, on how actually approaching risk analysis through fully fledged scenarios is a key way forward that should always be operational. That's our sense. And I think the pandemic is a key aspect where we had to devise very specific narrow approach for what was going on the real side, like was shown a bit on the agent-based modeling by Zhang. We had other approach for it, but giving a bit of short-term anchor, figuring out what could be scattering effects, composition effect on the very long term, the knock-on global, so also an architecture of what could be modalities of those scenarios by which the financial system would not so easily cope with it, and then let that run in models which are more or less current models can grasp from these stories, no, to the extent that they are well used. They also have been changed through the pandemic to also capture that a bit better. And just to flag that on average, that's how we come up with different type of scenarios. And here I show you one example you find in another visualization in the OP. So all the Eurosystem has been developing pandemic scenarios like contingencies around the central tendency, but models also have been moving along. See here you see what we call ECB Basir, which is a core model that we have augmented with an epidemiological module, just to be able to rationalize also the pandemic kinetics and these demand supply ramifications in a more stochastic sense. So scenario should be alive, and I think that's where unknown and multimodality in the outlook are a good place for modelers to stand up and provide contingencies to their models. The last point I will try to give is about more the medium-term orientation of model analysis and the medium-term reference scenario. And I think I would not need to show you the example now in the sake of time, but just I think other institutions are doing it. For us, we have some practice of having medium, like beyond the traditional forecast horizon, to extend it with the medium-term orientations. And I think the work going on at the ECB and potentially through the Eurosystem is to extend a bit this type of analysis and to locate there relevant simulation when it comes to policy analysis, in particular monetary policy, and perhaps long-run sensitivity and climate is ranking very high in how we would develop this medium-term reference scenario. And I would conclude to say that in our chapter, a chapter of our occasional paper is also about how we go about, how is the modeling community and within the Eurosystem and beyond going about exchanging practices and working together. So one aspect of it is about how we cooperate, and the event like this one is a very good example of building a community on exchanging practices and collaborated, but also infrastructure. And I would like just to advertise that bringing models towards policy is not only adapting them to the needs of the policy process, it's also making them robust technically with infrastructure needed to have, let's say, their organizing role fully taken up. And for us, the ECB, we do have a project that we just advertised in the piece, which is the Perform project, which is to have to be an end-to-end platform that has the potential to perform all the tasks, but also have the professional standards for using models. So if it's an art to pick the models and do them, it should be really a robust process to activate them for policy preparation. And on that, I would close my presentation, hoping that we managed to grab a bit of time back, Alessandro. Thanks a lot.
All right, so maybe we can have time for questions at the end. So the second speaker is going to be Eleonora Granziera from Norges Bank. So Eleonora, the floor is yours. Thank you.
Okay, so thanks so much to the organizers for giving me the opportunity to participate into this very exciting workshop. So I'm Eleonora Granziera, I'm a senior economist at the Norges Bank. And let me just jump into my discussion by starting with providing some of my thoughts about general considerations regarding macro modeling at central banks. So we know that central banks use their models to support their core functions, so forecasting, policy analysis, risk management, and communication. And one of the key modeling choices they have to make is actually the approach of choosing a core model versus a suite of models. So the idea is that, the core model approach employs just one single economic framework for all of the functions. And so the models need to include all of the relevant features for policy and projection purposes. Instead, the suite of models requires developing and maintaining a set of models, and each of the models can be optimized for a particular function. Now, it will become clear in the next slides why I made this point. And of course, then the next step is which models do we want to include. Now, the modeling choices should actually be reassessed and discussed in line of new developments. For example, new features and academic developments in computing and modeling, and of course, in the light of a changed economic environment. In this regard, it's very important to evaluate our macro models and test whether they constitute the best practice, they're appropriate to answer relevant policy questions, and can be improved, and how. Now, the ECB went through this review last year, but Norges Bank actually went to a similar review, although not of the monetary policy strategy, but of the macro modeling in 2019. This was conducted by an external committee, and our reference point were best practices in other central banks as well as academic developments. Now, let me jump into the points, keeping all of this scenario or background in mind. Let me jump into the discussion of the points that Matthieu raised. So let's start with the model-based economic narrative. Now, maybe I can skip, in the interest of time, the first block of points, because these are the problems that Matthieu have highlighted and recommendations. But let me just mention that I think it's important, of course, to obtain economic interpretation of macroeconomic dynamics and run counterfactual, because they are the basis for calibrating policy measures and to give appropriate communication, both internally and externally. And a fully fledged economic narrative for the baseline projection is actually instrumental to improving relevance, transparency, and accountability for policymakers. Now, in my view, some of the challenges that are that have been highlighted in the report actually stem from the fact that, as other central banks, the ECB is using a suite of models approach. Now, the pros of this approach are that it's very robust and flexible. The cons, of course, it's that it comes at the cost of possible inconsistency across the satellite structural models that are used for policy, for projections. For policy analysis and the projection models. And it's possible that it is inconsistent. Actually, it's in this inconsistency is going to be seen also across different projection rounds, and this actually makes it a bit difficult. Makes more difficult internal and external communication. Now, the Norges Bank approach is different because we follow the core model for projection purposes and policy analysis. So let me just give you a quick overview of our macroeconomic modeling. So the center of our analysis is NEMO, which is a new Keynesian DSG model that is used for all of the 4 functions I was mentioning above. A suite of models that are used to obtain the short-term forecasting of the Norwegian economy up to 2 quarters ahead, and some other models that are used for the external variables are actually inputs, or the forecasts from these models are actually inputs for our DSG models, but all the projections are actually stemming from NEMO, as well as the economic narratives. Now, we also, to conduct policy analysis, we also have alternative structural models, so structural bars, and lately we've been working on some Hank models. Now, here is an example of what we can do in terms of communication with the public if we use the core model approach. So what I'm showing you here is the composition of the change in the policy rate path. So as the Riksbank, we also published the policy rate path. And this is from our latest MPR report. So here, we can, on top of showing the projection, we can directly in our MPR show the structural interpretation of the projection baseline. And this is conducting using NEMO. So again, this framework allows us an easiness of communication, both internally and externally. And this narrative, it's consistent across projection rounds. All right, so let me go to the second point. So the issue for the second point is that the judgment-free model-based projections are not explicitly reported in the forecast process. And I firmly believe that actually it's important to store this judgment-free forecast for 2 reasons. First, they can help us to distinguish built-in features of the models. For example, persistence, forecast accuracy from the expert assumptions. And also they can serve as cross-checks of our forecast. So here is what I mean. So in terms of trying to understand model and bad persistence versus judgment, here is a figure that I show that I'm taking from some of my work with the colleagues from the Bank of Finland. And what I'm showing you here is on the horizontal axis, the forecasting horizon, and on the vertical axis, the forecast from the ECB quarterly macroeconomic projections. And in these shaded areas denote the maximum, minimum, and some quantiles of the distribution of these projections over time. And so one question that I came up with looking at this picture is, it's quite clear that regardless of the starting value, the ECB projections tend to revert to the target after 3 or 4 quarters. So one question that one could ask would be, whether this is due to some judgment or there is some persistence, inherited persistence that is embedded in the model that is driving this mean reversion. So in terms of using the judgment-free forecast as a cross-check, at Norges Bank we have developed this new platform called SMART, which is a comprehensive model system that brings together all our empirical models for forecasting of the Norwegian economy. So it's an upgrade from our platform that you might have heard of, because it includes models with time-varying coefficients, stochastic volatility, mixed frequency, and this came as a result of our modeling review. And also it uses high-frequency data up to daily, new data sources, such as, for example, debit card and payments data, and granular data. And we have a very rich set of administrative data, so we are actually incorporating those also into our forecasting models. So the models are trimmed and combined, and they provide one estimate for each of the variables that are used in NEMO. So these forecasts are actually used to initialize NEMO. And they are produced for the whole projection horizon, and that's why I'm suggesting that this will be used to cross-check our forecast. Now, the medium and long-term goal is actually to have this judgment-free forecast live on our website, at least for output and inflation, and this again, in our view, would increase our accountability. Now, again, to stress the importance of cross-check, so these judgment-free time series model are very useful, both in order of to evaluate the relative forecast accuracy of the models. Again, we have this baseline projection from NEMO, so it's important to evaluate its relative forecast accuracy from a historical perspective. They're also important, so this is a project that we are working on right now, to trying to understand to track the distance between the models over time. We find that it is itself valuable information. So what I'm showing you here is actually the distance computed as the norm between the forecast from the BIVAR and NEMO, averaged across 12 variables and 8 forecast horizon. And you see that in period of heightened uncertainty, this discrepancy between the models is really shooting up. So this could be, we're thinking about how to use this kind of information as an alarm that actually goes off to signal troubling times ahead. All right, model risk analysis. Now, I think that the performance of density forecast accuracy should be performed in terms of, when the models are actually augmented in order to produce density forecast, or if new models are developed. Now, one difficulty that we find with the density forecast is that, of course, as was mentioned in previous presentations, some models might not be equipped to produce density forecast in presence of large shock. So let me give you an example. So Norges Bank has been published fund charts that are based on density forecast from NEMO, and this has been going on since 2008. However, we stopped publishing these fund charts. So this is the fund chart for the policy rate. We actually stopped publishing this fund chart in 2010 Q1 because NEMO was simply not equipped to produce density forecast in this uncertain environment. On the other hand, this gave us the opportunity to try and explore alternative ways to produce density forecast. So again, this is taken from my own work. These are the density nowcast of household consumption in 2020 Q1, obtained using Midas quantile model regressions. So this is the actual realization of the variable, and these are the density forecasts. And as you can see, this this quantile regression was very important in order to allow us to obtain skewness in the distribution and into account the increase in riskiness with the pandemic. All right, model-based monetary policy evaluation, it's important to revisit models to eliminate unappealing features, such as forward guidance, or to include important ones, such as financial frictions that are relevant for monetary policy transmissions. However, on top of revising the old models, of course, as Jan was pointing out, there is a need of new models to address new questions. How to incorporate climate change into business cycle analysis, and how to address inequality. Now, our experience has been, again, we use NEMO that has been gradually enhanced through time. So, for example, we've included the banking sector, the housing sector, but, ad interim at least, we use complementary set of models for other relevant policy questions. For example, there is a heterogeneous agent group team which is working on developing heterogeneous agents models with housing in order to try to understand how household will respond to a tighter monetary policy. We know already that modeling heterogeneity directly predicts a stronger impact on consumption from the interest rate changes than from NEMO. We want to understand whether bringing the policy rate back to normal might hold back consumption more than would be warranted by simulations conducted in NEMO. And so for this reason, we are comparing now aggregate consumption responses from NEMO and the Hank model. Okay, almost done. Enhanced medium-term reference scenario. Now, again, in response to our own macroeconomic modeling review, what we have done is to actually thinking about how to, the issues of trends that might be subject to breaks. So there might be shifts in one or more of parameter values in structural models that are specified in gaps. All the variables now enter NEMO in gaps, although there is a long-term plan to let them enter in levels. But at least so far, what we've done is to include structural breakpoints through new solution techniques. So this basically help us to answer two questions. And these are actually documented in some staff memo. The first one is we changed actually the inflation target in 2018, and we went, I think it's a bit different from the directions that everybody was thinking about. Instead of raising the inflation target, we lowered it from 2.5 to 2. And also in 2019, we assumed that there was, maybe we're going to revise this assumption now, but a decline in the long run exchange rate, actually a decline in oil price, which had in turn determine a long run exchange rate decline. All right. Okay, so the last minute I have available, I just wanted to talk about something that hasn't been really touched in the presentation by Matthieu, and I haven't really seen outline in detail in the paper, which is, data are actually pervasive of all our model, and maybe I'm biased because I'm an empirical, empirical time series macroeconomist, but I wanted to talk about the importance of data, both in projections and in scenario analysis. So I think that in the last, especially during the pandemic, we actually have seen a large number of new high frequency and granular types of data that have become available. Now I'm thinking, about payments data, Google Trends data, other indicators from the supply side. And I think there is a big need to explore their usefulness, both in forecasting and policy analysis, and especially assess how they're important relative to existing data. So let me give you a specific example. We actually have seen, so before COVID and before having access to the payment data, we used retail sales to nowcast consumption. Now, if we didn't have access to debit card data, we would have used retail sale to nowcast consumption during the pandemic. And what we would have seen is that we would have predicted a decline of about 1% when the pandemic hits, and about 5% at the end of the quarter. But actually, using debit card transaction data gave us an outcast of consumption that was extremely accurate. So I think, this kind of data are very important, of course, for nowcasting. Now, an effort that we are conducting at the bank is actually trying to link this debit card and credit card data with administrative data to inform Henk models and understanding the response of consumption and different categories of consumption from different types of households. We also use textual data to construct financial condition index, analyze the component of uncertainty, and to forecast house prices. So I believe that there is also an avenue, fruitful avenue of research to incorporate this new kind of data to inform and discipline our models. And with this, I will stop. Thank you.
Thanks a lot, Eleonora. This was very interesting and definitely complemented to our analysis and view. So the next speaker and the last one of this session is Francesca Monti from King's College. Francesca was previously at the Bank of England, so she will give us the perspective of someone who has seen this from both sides. So Francesca, thanks for being us, and the floor is yours.
Thank you very much for inviting me to this this event, which has been really very interesting for me. It's already 2 years that I have left the bank. I haven't stopped thinking about these issues because they are very close to my research, at least a part of my research. So what I will discuss reflects indeed my past experience at the Bank of England, but also I will focus my comments on some research that I think is relevant in this area, and that I some on my own, some of others that I think can be useful in understanding how to indeed improve the use of models for monetary policy. So this is indeed a really kind of complex issues. I think from all the previous presentations, it's clear that there's a lot of it is a multifaceted issue. So if I want to, kind of aiming to create a rough picture of it. So what are the key challenges when preparing projections for monetary policy? So indeed, one of the, the first step is constructing a forecast with a whole suite of models and judgment, which is very different from producing a forecast with, basing yourself only on the output of one model, using one model and producing it in that way. And then, and this is something that has maybe been discussed a little bit less throughout this talk, is thinking about policy, optimal policy in particular, around that judgmental forecast and thinking about it in a consistent way. So what I would like to do is to delve first a little bit deeper into what are the issues around constructing a forecast with a suite of models and judgment mean. So why a suite of models, which I think is what most central banks use, in the sense that, models are maps. So, we use them to think about the economy in a more structured way. Different models serve different purposes in the same way as, if you have topographic maps to understand the landscapes and cadastral maps to understand the claims on the land and the values and so on, and political maps. Similarly, as has been clearly discussed in many talks before, different models are used for different purposes. And if, giving a slightly superficial kind of overview of it, then one can say, structural models are used for policy analysis and scenario. Time series models are used for kind of short-term forecasting and kind of monitoring of macroeconomic conditions, so nowcasting. And then there's these semi-structural projection models, which effectively are useful for bringing together. They're flexible tools that allow you to have less story than, let's say, structural models, but allow you to bring judgment into the forecast much more easily, and therefore tend to be used as a sort of a organizing framework to produce the forecast. And so it's natural that central banks tend to use different models to harness the strength of each of these models, but this kind of naturally raised the issues of how do you achieve a consistent story across all these models? How can you make the narratives, consistent, compatible? And obviously, even if you were able to do that, there is always something that is not fully captured by the model. So judgment is crucial, and therefore, even in that case, you still always need to bring judgment into the model. So also based on the talks we have seen before, different central banks tend to have different, let's say, central models in their forecast suite, if you want. Some might have DSG models, some use as a central model a semi-structural models. There's clearly different compositions of the suite, different in terms of richness, in terms of the models that are used, but the trade-offs are clearly similar. Different central banks are on different kind of spectrum, on a different place in the spectrum, but face similar trade-offs, where one is, the theoretical consistency of the central model. Are you using, for example, a DSG as a core model, which has more general equilibrium narratives versus is your central model a semi-structural model, which is much more flexible in terms of adding blocks, etc., and adding judgment, but has the disadvantage that the stories that come from it tend to be a little bit more partial equilibrium. Then there's obviously the question of what is in the central model versus what goes in the suite, and how you bring them together. So every time that there's an issue, an economic issue that becomes relevant, the question becomes, should this be reflected in the central model, or can it be a suite model? And then how do we bring in the insights, the narratives from that model into the central model? And indeed, this kind of consistency and compatibility across the narrative. So for example, if you are using the new area-wide model for your stories, how do these stories then, how exactly do you reflect the stories of the new area-wide model in the semi-structural model? Because these are issues that in any case have been faced and are being faced, I think, all over. There is a lot of kind of interesting research and development work that is being brought forward. And that is what I want to kind of delve into. And obviously I will talk about some of my work, but also others. So, but to start, thinking about the consistency across models. For example, Eleonora was just saying, we tend to initialize. We have our core model, which is a DSG model. We use short-term models to produce, nowcasts, which then we use to initialize our model. But the question that, one could ask is, okay, so you're producing the nowcasts and your structural analysis with two different models. On the one hand, you have your DSG, it could also be your SVAR, and so on. And on the other hand, you're using your factor model or other types of model to monitor macroeconomic conditions, do the nowcasting. Is it possible to use a common framework to do this, and in some sense to use a structural model in real time so that it kind of gets updated with the real-time data flow in a more, formal way, if you want. And the answer, my answer to this is yes. And there's some work that I have done in the past with Domenico Giannone and Lucrezia Reitlin, where we show this in a more recent paper with some actually also colleagues at the European Central Bank, so Michele Lenza and Jacopo Cimadomo and Andrei Sokol, who was there at the time, together with Domenico, where we do this in the context of AVAR. So I just wanted to show these two results in some sense in a couple of pictures, and then pass on to some other of the issues that are relevant in terms of forecasting with a sweetened judgment. So what I wanted to show is in the paper with Domenico and Lucrezia, we effectively take a relatively standard DSG model, slightly richer than does Metz and Wouters because we have an investment-specific technology shock and a network shock, and we show that we can augment it with some auxiliary kind of monthly variables to get us some sort of real-time assessment of the model story. So here I'm showing you a structural shock decomposition that comes from the model. We did this before, the crisis, before 2020. So we're focusing on the one that looked to us at the time as the crisis. So 2008 Q4, this is US data. And the model gives this kind of structural decomposition into some of the shocks. And then we ask, if you were a policymaker at the time, given just, the model with that is looking only at quarterly data versus the model that is able to update itself with the kind of monthly data flow, what would your assessment of the crisis have been? So, ex post, this is the structural decomposition that our model gives for 2008. So 2008 Q4, pointing to, a risk premium shock having a big effect, investment-specific technology shock being important, etc. That's not so important. What I want you to notice is that these graphs are representing the same point in time. So they always look at 2008 Q4, but given different information sets. So this is your structural decomposition of 2008 Q4 when you had, data only up until July 2008, August 2008, September 2008, and so on. And what you can see is that, with your ability to incorporate the information from the model, you are, from the auxiliary monthly data flow, you're able to update your story that you would tell, for example, to the policymakers much sooner in terms of what shocks were really important. Which then brings me to another kind of counterfactual that we do this time with a large BVAR in the paper with Jacopo Cimadomo and etc. All the others. There's a lot of co-authors in this paper. So where instead here we have a large Bayesian VAR for the US economy, which includes, important macro variables, but also kind of more high frequency information variables like housing starts, etc., and the variables that are generally looked at by markets. And we ask ourselves the question of what would the Fed funds, what would the model say that the Fed funds rate should be if it observed the data for, inflation and GDP that was, the one in 2008 Q4. And what you can see is that the model, the high frequency large beaver that accounts for, all the mixed frequency information is much quicker in realizing that the policy implied by the data that it's being observed in this point in time should be lower compared to a quarterly model. So this is to say, there's definitely steps that are being done in terms of bringing together, for example, the analysis, short-term macroeconomic conditions and structural analysis in interesting ways. Now, even if you were able to do this, really well and make the models as compatible as possible, judgment still remains a crucial part of the forecast. As Matthieu was pointing out, there's judgments that come in at different stages of the process, and they remain central to the projection process in a central bank. One point that I think is really important, and that also Eleonora pointed to, and is also, I think, reflected in the occasional paper, which I think is kind of really crucial, is the importance of trying to make sure that it's clear what is the impact of the judgment versus the model. And so the using the model-based projections, at least as a tool to help account the impact of judgment, I think is really important. There are other kind of interesting papers about forecasting with judgment, which I wanted to highlight. One is mine, where I kind of put together forecasts that are generated by a structural model and judgmental forecast, which is obviously intended to improve the forecasting performance of the model, but it's also a way the methodology I propose allows to use the model to kind of assess the informational content that is in these judgmental forecasts, which I think can be useful to understand when the judgmental forecasts are being really bringing information versus not. And so, for example, which, if you're bringing in the judgmental forecast from some models versus others, you could assess which model is being is bringing in more information versus the others. There's then some interesting work from some colleagues who at the time were at the bank. Now Dario Caldara and Anya Lipinska are at the board, but they were at the bank at the time, where they propose a really nice way to bring in shocks that are originate in sectors that are not present in the central model. For example, a housing sector for Compass, which didn't have it. By proxying this missing sector through a small, set of factors which feed into the structural shocks of the central model and create correlated disturbances. And so this is a kind of a neat way to bring in judgments in some sense, and missing channels from other models. There's then a recent paper that I've seen by Paolo Gelain and Manganelli, who is also at the ECB, on looking at monetary policy decisions as judgmental, and there's interesting insights in there. The second to last, actually, point, I was going to say the last, but it's the second to last point that I wanted to make, has to do with optimal policy projections. Now, in my, I hearsay possibly dated experience, in the sense that I have not been at the bank for the last 2 years, but so, you know, I'm not sure how things have changed, and, you know, definitely whatever I have said reflects my views and not the views of the bank. But in my past experience at the Bank of England, I found that these optimal policy projections were useful, really useful, and, you know, as a starting point for discussing monetary policy around this judgmental forecast that was built. They were also used in speeches. I put here some example, the famous Lambda speech by Carney, but also a speech by Silvana Tavero in 2018. And I've seen, so I obviously have in mind the toolkit by my ex-colleagues at the Bank of England, Richard Harrison and Matt Waldron, who have developed a toolkit to do optimal policy analysis around a judgment-based forecast. But while looking at this, I realized that there's a very similar toolkit produced by economists at the ECB, Oliver de Groot and you know, others, which I realized is produced in parallel and kind of very, very similar. So I would be interested in understanding how much that is used and how it's used in policy discussions at the ECB. One final point that I then wanted to make before kind of some final observations is that indeed, as everybody else has noticed, incorporating risk assessments in the forecast is really kind of crucial. And this is not just risk assessments. I mean, the points here are two. One is about model-based risk assessments and how to improve those. And the other is how do you bring judgments about the risks into the forecast. And so for the latter question, so judgmental kind of assessments of the risks around the forecast, I think that methods like entropic tilting can be, really useful. And there's this recent paper by Anna Galvao, Garrett and Mitchell, who show, at least analyze how looking at different higher moments, not just the mean, but also higher moments of the distributions of judgmental forecasts is helpful in, informing the model's forecast, whether it helps in its, performance, its density forecast performance. There's a recent paper by Andres Sokol, who proposes a kind of conditional quantile regressions, which allows to generate density forecasts that are consistent with a judgmental kind of view, the future evolution of certain variables. And then, the last point that I wanted to make is that that BVAR model that I was showing you, where, where we kind of, if you want to do analyze the real-time data flow in the context of this mixed frequency BVAR, is also able to respond to the incoming data, characterizes the uncertainty also in response to the incoming data. And so here I just wanted to show a joint distribution of CPI inflation, this is for 2020, and GDP growth, and the way that the model would have perceived them, have generated them in January of 2020 when, the crisis was not in sight. And so it was a nice kind of very clean distribution around, 2% and, reasonable numbers, tight, relatively tight distribution. But by the time we reach May 22 of 2020, and that, the COVID crisis had struck at that point very clearly, you can see that the uncertainty of this joint distribution has, expanded a lot. So some final observations. I really like the idea of having a perform, the perform toolkit. I think it's great, but I do think that it's really important to envisage staff for the maintenance of the code and the models, because I think this is one of the things that is kind of often overlooked, and that then ends up being, difficult if there's no then proper maintenance of this kind of big platform. So I think that's definitely something that is really important. And then my other kind of final observation is that as problems crop up, it's always tempting to say, oh, let's add additional block on my central model, but I'm not sure that that's always the best solution. And I leave you with a long quote that I'm not going to make you read, but that it's ultimately from bringing me back to the map analogy from a book of Lewis Carroll, where he talks about some people trying to do a one-to-one map of reality, which ends up not being very useful or used. Thank you very much.
Thank you very much, Francesca. This was very interesting. I would just like to thank again all the participants and the organizers for this very interesting workshop and conference. I look forward to other events like this in the future. I think we all learned a great deal today from, different perspectives and different experiences across the ocean. So thanks again.
This concludes our workshop for today. Thanks again to Matthieu, Juha, and Alessandro, to all speakers and moderators, and to all of you for participating and for your interest. Thanks again. Hope to see you soon, and interested colleagues also for future SUERF events. Bye-bye and take care.
Thank you.
Thank you. Bye.